Markets after the experience of last year, I think, is how most people down would.
Yeah, I mean, I think
would summarise
the sort of the way it was last year is the markets punish Liz Truss. We're still getting back to a world of trying to get things into a normal place. Yields are higher. That's
the funny bit about all that.
That's hitting the fiscal space.
Yields in some places have been above where they were back then when we had the mess.
Quite. And that means. Sorry, Tom, you go.
No, I don't mean to interrupt, but this is important. Lisa, should we move the show here permanently?
Because of...
We got guys like Dan Hansen, and we can get up later than the 3 a.m. act
I think that's the important piece of this, right? The fact that it's midday.
You're going to be in training to cross the street, and then we'll see.
I just think
you can look the right ways.
You want to make happen. We talked about this a long time ago, about maybe moving the morning show to the afternoon in London.
I could get Todd's tickets, and
I'll carry on saying good morning. We'll be season ticket holders, TK.
Yeah, see,
can make that happen.
I could, Adele can come talk to me about Tottenham.
We can have Adele sit around the table, sure.
Yeah.
Dan, it's good to see you.
Yeah,
Thanks for this. Dan Hansen, Bloomberg Economics, looking for that rate hike.
Dan says we should move
in about 5 minutes' time. Yeah. That Bank of England rate decision just around the corner. I said it was a central bank in triple header, and we're a third of the way through. We've had the Federal Reserve, the Bank of England still to come. That decision in about 5 minutes' time. Guy Johnson's going to break that one down. And then tomorrow, it's the BOJ. Here's the setup for you. Stocks pulling back yesterday, pulling back again this morning. Equity futures down by 0.6% on the S&P. Some headlines in the bond market. 440s in the 10-year, 442.53, yields up a couple of basis points on a 2-year, pushing 520 a little bit early this morning, currently pulling back to about 515. Your Bank of England rate decision is coming up next. Live from London. Good morning.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
We intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
We're running strong growth. We're running inflation that's above target, so it makes sense to guide towards higher for longer.
There is a concern on the other side of this that they're going to need a higher neutral rate.
The economy has changed since the shutdown restart, and the Federal Reserve is still struggling to come to grips with that.
The Fed delivered exactly what they wanted to, provide a hawkish sap that allows them to speak more dovishly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Well, there's a split decision. Live from London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. And I'm not talking about the Federal Reserve. Rates unchanged at the Bank of England, Tom. The vote split, 9 members of the MPC, 5-4 in favour of maintaining interest rates exactly where they are at 5.25.
This is a surprise. It'll be interesting to see the defense makeup. You see a 5-4 in terms of maintaining. That's the kind of tension, John, maybe obscured in Washington. It's very visible feet away from our offices.
That's the decision. Here's the signal they want to send this morning, Lisa. Further tightening required if inflation persists. It feels like this week's CPI print, bit of a game changer for this BOE.
I want to hear, though, from the specific members. And what I think that Tom just said there is actually really important, that maybe some of the confusion that we heard from Fed Chair Jay Powell trying to put a narrative around projections is really displayed more in the fore here when you have a 5-4 decision. It's like a Supreme Court decision in the U.S. where you have people lined up on both sides with evenly split types of situations. It raises a question of whether this will be helpful for the Bank of England to go out and say, we just don't know, or whether it will be harmful in terms of credibility and guidance.
You wanted to know what it meant for pound sterling, so let's talk about that. The pound against the US dollar, 122.65, just rolling over, just a touch more. We're negative on that currency pair by 0.6%. Any similarities between this decision, Bramo, and what we heard from Chairman Powell yesterday? My conclusion, whenever we ask that question, is no.
It's a completely different economy. I think that that's important. I think that the fact that all of the central banks that we've been tracking seem to be reaching the peaks of where they're going to at least pause and calibrate whether they need to raise more rates highlights what they talked about is that, you know, the risks on both sides are becoming more evenly calibrated. Yeah. And that seems to be very much here, even though Governor Bailey says there is no room for complacency.
John, you're better at this than I am. Conliffe, the deputy governor, Megan Green, Catherine Mann, and Jonathan Haskell, they voted to raise rates. And I think a key question here for particularly Catherine Mann and Megan Green, who we know so well at surveillance, is what was the single justification to raise rates that the majority pushed against?
Clearly, they didn't pay much attention to that inflation report yesterday and wait the decision just on that, because Nomura and
on
Goldman,
a real rate analysis,
they dropped their calls on a rate hike this time around, based on that print this week.
I can voice the wonderful Dr. Mann, who I've known for decades. On a real rate analysis, they have to raise rates.
I asked about similarities between the Federal Reserve and the Bank of England. This language might sound somewhat familiar, that policy must be restrictive enough for sufficiently long at the Bank of England. Guy Johnson standing by outside the British Central Bank. Guy Johnson joins us right now. Guy, your take on this one, please.
I think they're using the vote split as a signalling mechanism. They're signalling that it is very difficult at this point to make an accurate decision on where the economy is going, or get an accurate kind of feel of where the economy is going from here. Basically, what we're looking at here, John, is a balance between the inflation data we've seen this week and the wage data we saw last week. The wage data was strong, the inflation data wasn't, but within the inflation data, some of the things that dragged it lower are quite volatile, so we can't really at this point make an accurate call as to what happens next. So clearly, the Bank of England has made a decision that for now it can wait and see what happens with the economy, see what happens over the next few months. They've raised rates by 14 times already. Are they going to continue to raise them further from here, or are those 14 rate hikes going to be sufficient to slow this economy down, to raise unemployment, to take some of that steam out of the wage debate that they want to see at the moment? The other thing I should flag as well, John, is that they have raised the QT target to a higher level than was anticipated. So there is some hawkishness there, and I wonder whether or not that is what the hawks will take away from this. They've gone to 100. They were at 80. There was some talk that they would go to 90, but they've gone to 100. So maybe that's where the balance comes in here.
Guy, I mentioned the CPI print that came out earlier this week. We also need to talk about the growth profile in the United Kingdom. A curious headline across the Bloomberg from the BOE. This from our colleague Luke Morano, pointing out that policymakers saw UK PMI surveys due out on Friday. Guy, from your perspective, what would you expect to see Friday based on that headline?
Maybe some weakness. We'll hear from Chris Williamson and his data tomorrow at market. We'll see what that data tells us. But that data has been weakening quite significantly. We've already seen, obviously, weakness within the manufacturing sector. That's been there for a while. But the last set of data told us that we're starting to see some weakness into services as well. And that could have been, John, the tipping factor that maybe led to this vote split that we've got here. Maybe we're not just balancing out that wage data, that CPI data. If you fold in the PMI data, which, as you say, maybe they've seen, that could have been actually what tipped it the way of a hold rather than a hike. Tom?
Guy Johnson, you're knee-deep in this on a daily basis. How much are experts tilted towards a recession call in the United Kingdom?
I think there probably seems to be a growing majority of people that do feel a recession is coming or may already even be here, Tom. That's the thing as well, that the recessions are usually only observed with hindsight, and it looks as if the data are deteriorating here. The UK economy obviously is very hard to call at the moment because the ONS keeps revising the data, so very difficult to get an accurate kind of assessment of what is happening. But there does seem to be some evidence that this is an economy that is slowing down, maybe is slowing down relatively rapidly. There is still a lot of policy tightening in train, i.e. that is still to hit the economy. And as a result of which, maybe that is the conclusion of the Bank of England, that they are now seeing some of the effects that they want to see. That slowdown is coming, but maybe they just need to see more of it in the wage data to conclude that they're not at the top of Table Mountain, they're at the top of the Matterhorn.
Interesting. Guy, thank you. Appreciate that analogy as well. Guy Johnson, thank you, sir. Out of Bloomberg at the City of London on the Bank of England's latest rate decision, unchanged, 5.25, but a big split on that committee, 5.4. And Lisa, I think we've got to pick up on the growth profile, not just the inflation story. Growth in the United Kingdom, the outlook coming from this Bank of England, not exactly sending this really positive signal about the outlook, are they?
It's completely different than the U.S. When you talk about the similarities, this is a pretty big distinction. They revised downward their third quarter GDP growth to 0.1%. It had been 0.4%. So they are looking at weaker growth, not stronger growth, and they are adjusting accordingly at a time possibly to justify why they kept rates on hold for the first time in nearly 2 years.
All will adapt, and very importantly, asset managers will adapt. With Aberdeen, Sri Kochagovinian joins us this morning, their senior research economist. The growth issue there is just absolutely tangible and germane to a shop like Aberdeen as well. Are you calling for a recession when you see the split of that, the tension of a 5-4 decision?
I think that's right. We are looking for a recession later this year, actually, and one that continues well into next year, possibly the first 2 quarters as well. Now, if we look at the data that we've seen recently, obviously there can be some revisions in the GDP data. We saw quite a contraction in July. Now, we are expecting, perhaps there are some quirks in the data, that we haven't seen as much industrial action recently, and there could be some technical issues and a rebound. But I think the outlook for the rest of this year is quite weak. And we see that, as you've mentioned, in the PMI surveys, both manufacturing and services moving into contraction.
Let's talk about the market response. You are seeing a weaker pound in response to this, as many people expected it would. At what point are they between a rock and a hard place at the Bank of England? If they don't hike, the pound weakens, it increases inflation, even as growth slows. How much is this going to be a real consideration for them going forward?
I think obviously imported prices are going to be a consideration, but what we saw earlier yesterday in terms of the inflation data was very promising. And I think one of the key metrics that they focus on, what really changed, was that core services data. We saw a deceleration there as well. But I think it's still very elevated. We are still seeing another key metric of wages are still very high, and hence this signaling through the split and the announcement of QT. Something that we've been expecting for a while is that they will increase the pace, the run rate, but they've done that today, and I think that's an interesting communication
Well, what is the signal, right, from the split, other than they're just divided? It is a difficult moment. What is the signal that you can take away as an economist coming up with your own projections?
I think really what we're seeing is they are worried about the recession. They are worried about weaker growth, and they think that perhaps going into the rest of this year, inflation is likely to continue to decelerate. So what we're seeing is the lagged impact of fairly aggressive monetary tightening really starting to bite. And they're probably thinking, right, that here is a time to pause, but we don't want to get too complacent. There are still a lot of inflationary pressures ahead, and there's a long way to go before we go anywhere near target.
Sri, help us understand the bond market move in the gilt market right now. 10-year gilt yields are higher on the session, near session highs, up about 7 basis points. Does that stack up for you?
I think it's a knee-jerk reaction, perhaps. You know, the hawkish signal there is really being the focus, I think. But what we will say is, even though we are very close to the peak, we do expect rates to remain elevated, and we're thinking more Matterhorn rather, more Table Mountain than Matterhorn, really. So really on hold, elevated for a long period of time, well into next year.
Could I offer an explanation? Do you think to some extent this might be a Bank of England that's starting to become more concerned about growth over inflation, and a bond market starting to pick up on the scent of that?
I think there is a shift. I mean, it was a very, very close call, and I think that inflation number really sort of tipped this decision. There are some other disinflationary pressures with, food prices are likely to continue to drag down inflation to year end. But as you say, we're still nowhere near target, and I think that the growth priority is starting to pick up.
Back to your work at Queen Mary in London, do you find it more beneficial to have a highly visible, dissenting, nuanced split vote like at the Bank of England, or is it are you more able to make theory and forward-looking views over the "we are the world, we're all in it together" view of the Fed?
I think the split is part of the signaling. I think that's actually quite a useful signal, and you can see that in the bond markets. They're taking this as a hawkish pause, and that's actually what is necessary in a sense in order to continue on this path of disinflation. Unfortunately, we need a recession to really correct some of those imbalances that are quite particular to the UK economy.
No change isn't boring, TK, in London. No change is not boring. 5-4 split.
I'm fascinated by it, and to know the heritage of Catherine Mann at MIT and Megan Green at Oxford, and these are huge decisions, folks. This is not a small matter, and I go back to the real yield. I know Kit Jukes is all over that in his morning note as well.
Sri, thank you. Sri Kochagovindran of Aberdeen. If you are just tuning in, welcome to the programme. Equity futures, session lows, negative 0.7%. A lot going on in this bond market. Yields up 2 or 3 basis points on a 10-year, 443.54. A little bit later on today, Jim Bullard, the former St. Louis Fed president, sits down with Bloomberg's Mike McKee.
Well timed.
We were wondering, Bramo, you and I talked about this a few times, would we hear less from Jim once he'd left the Federal Reserve? And we happen to be hearing more from Jim Bullard since he left the FOMC.
It doesn't completely surprise me. He's never been one that's shy to share his opinions, and I'd be curious what he has to say about what we were just talking about with Sri, which is growth trumps inflation, essentially, for this Bank of England. Is it starting to do the same for at the Federal Reserve? And was that sort of the subtle messaging behind, well, we don't want to say Goldilocks is our base case, but it's not our base case, because check out our forecasts.
First of all, it's un-American. He's got an Indiana University PhD, and he's got a shingle out at Purdue. He's boiling up, and I don't get it. But the answer is Jim Bullard's going to tell you we will not roll over and die with high interest rates. That's going to be his core belief.
I wouldn't go as far as saying that growth is more important than inflation in the Federal Reserve. I would say this, though. This Federal Reserve, based on these projections, if you want to ascribe a meaning to the median, to pick up on some of the language that Chairman Powell used, they're basically forecasting that growth doesn't have to get hit that hard to get inflation back to target.
And they are forecasting they're not going to have that very difficult medicine of higher unemployment to face off with as they potentially raise rates further.
No change at the Bank of England, plenty of changes elsewhere at the UN General Assembly. Bloomberg's Anne-Marie will join us next from New York, live from London for our audience worldwide. This is Bloomberg Surveillance.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Today, Surveillance is live from London for the Bloomberg Global Credit Forum. After a decade of cheap credit, Tom, John, and Lisa address the risks in today's debt markets and the opportunities ahead. Tune in at 10 a.m. Eastern, 3 p.m. London time for the special episode featuring an interview with Apollo's Jim Zelter.
I got my hands full.
Only on Bloomberg. Context changes everything.
The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
No change at the Federal Reserve, a hawkish pause. That's what a lot of people on the South Side are calling it. That was Chairman Powell at the news conference just yesterday. A triple header of central bank decisions this week, three major ones anyway. The Federal Reserve behind us, the Bank of England just behind us, the BOJ still in front of us. On the Bank of England, unchanged, but a 5-4 split. So 5 voters of that 9-person MPC voted to keep rates unchanged. Lots to discuss. The price action at the moment looks like this. Equities near session lows, down by 0.75% on the S&P 500. The Nasdaq futures really struggling, down about 1 full percentage point off the back of this move in the bond market. Yields up by a couple of basis points on a 10-year to 4.43 on a 2-year.
Yeah.
Very close this morning to breaking 520. Pulling back since then. We're down about 2 basis points at the front end, Tom. 5.15 on a 2-year yield.
Kitchut's scheduled to be with us later. We'll do some really careful real yield analysis on that, Jim. But John, I'm going to do some Nasdaq 100 analysis, the roulette wheel of the American stock market, and it moved off the Bank of England. The fact is, we were down, but there's a leg down off the BOE news. This has got a global feel to it. I really wonder what the knock-on effects is to a unique and fragile Japan is as well. That BOE decision, what does it mean tomorrow for the Bank of Japan?
If you want some more direct knock-on effects, I would go straight to pound sterling. We gapped lower just a little bit on the pound against the US dollar. We've bounced back since. The pound cable, so to speak, 122.71. We're still negative on the session, though, by 0.6%. The outlook for the UK is messy, Bramo. It's not like the United States. The Federal Reserve is saying, yes, we can get inflation down, but no, we don't have to see too much pain in the labour market or, for that matter, the broader economy. For the UK, there's a concern about what we might see now in the PMIs that come out on Friday, tomorrow.
And you were talking with Sri about the idea of growth trumping inflation. Do we continue to see that right now in the UK, which is maybe why there is this knock-on effect? At this point, around the world, maybe for different reasons, but around the world, isn't there a sense that we're going to have higher for longer, and that's really the pain's going to come in, is maybe next year when rates are at this level?
High for longer, there are similarities, different consequences. We can all agree on that, based on the projections we're getting so far, Tom, from the Federal Reserve and what you're hearing from the Bank of England this morning.
We'll address this more in the coming days. Is a recession in the UK like a recession in Germany? I don't think so. I think they're two different beasts.
In what way, Tom? Manufacturing versus services?
Germany's a massive manufacturing, exporter, relationship with China, and I think England's its own unique beast.
When it comes to inflation, though, big exposure to the FX channel. Dan Hansen of Bloomberg was talking about that.
Well, yeah. What do they do with their models here? Do they break down
122 doesn't help.
119?
I don't think 106, 107 helps the ECB, for that matter, either.
Yeah, it's going to be interesting to see. We're going to turn our attention right now to Washington. 3 or 4 ways to go with Anne-Marie Horton, Bloomberg shutdown correspondent, with us this morning. How close are we to shutdown? I know it's X number of days out. Are we going to fly back, Anne-Marie, to a Washington shutdown?
Well, we're 9 days away, so they do have a little bit of time, so I imagine you'll be back, and the government will still be open, of course. I believe you're coming back next week, Tom. You missed our bilateral meeting we were supposed to have here in Manhattan, but When they come back, I cannot say whether or not they will have an agreement. They probably will not. What we are seeing, Speaker McCarthy held a meeting last night. It was about 2 hours, and it does look like he has been able to flip some members of the rebellious, if you will, right flank of his party who are refusing to sign up to the continuing resolution that he wanted to put on the floor, but still unsure if he has the votes yet. What he is doing is the debt ceiling strategy, which is make sure he can keep his party together, the Republicans together, to pass a bill, even though this is going nowhere with the Senate, which is controlled by the Democrats. But at least he's able to show his right flank of the party that he's explored all of these options. And even in that, there's a $64 billion cut to what was already agreed upon with the White House with the debt ceiling negotiation. But then it does potentially give him some cover to that when a more cleaner continuing resolution comes to the floor, he's going to have to work with Democrats to get that through.
So Civics 101, if the rebellious, as you call them, I love that, if the rebellious shut down the government, can the Senate block that shutdown action?
Well, the Senate can also work on their own bill, and then that will have to go over to the House. There's going to have to be a conference. There's going to have to be a dialogue at some point once everyone goes through these exploratory measures of their own kind of bills that they would like to see in their respective bodies. They're going to have to come to some sort of agreement that gets past the finish line. The question is whether or not they can do that before October 1st, or if they're going to need some more time and we would see a shutdown.
And I'm sure we'll be talking about this with you over the next 10 days ad nauseum as we get closer to what many assume will be a almost sure thing of a shutdown. Anne-Marie, one of the things that's on the table is funding for things like the Ukraine war, which has gotten actually increasingly controversial, not just in the U.S., also recently in Poland with questions around arms deliveries. We do know that there have been discussions between Volodymyr Zelensky and President Biden. What's the latest in terms of the pressure on stopping some of the funding on the U.S. support for Ukraine in this war?
It really depends who you ask, and we should note that the funding for Ukraine is not even in this continuing resolution, so they're going to have to deal with that separately. But while Zelensky is here in New York, and I actually saw him speak last night and spoke to some of his aides as well, the big meeting for him is not going to be the Oval Office meeting, which he is going to ask for those Army tactical missiles. They're called ATACMs. They have been asking for them. There's been reporting that potentially the White House is going to go ahead with those, and maybe we'll see some movement on that today. But the bigger meeting is when he goes to Congress. And I spoke to one of his aides last night, and they said that Mitch McConnell, the Senate Minority Leader on the Republican side, and Speaker McCarthy will be in that meeting. And this for them is really paramount, because the White House has asked for more than $20 billion for more aid for Ukraine in that supplemental spending package. And there has been concerns from the Republican Party, and also in some of the polls you see of just the American electorate, about where that money is going. And you could see that in a Wall Street Journal report today that looked at this letter from some Republican members of Congress asking the administration to explain what is the end game when it comes to Ukraine. So for Zelensky, that is truly the most important meeting he has.
And in the U.S., there's a question about wrangling all the troops, so to speak, in Washington, D.C. But how much is the U.S. still on the same page with its allies as well? I mean, there seems to be a splintering more broadly around the tolerance at a time where fiscal spending is constrained.
Well, these questions, to your point, are not just happening in Washington, D.C. They're happening in capitals across the Western Alliance. They're happening in Warsaw. They're happening in Berlin. People want to know, to what end are we going to continue supporting Ukraine if we are dealing with our own problems at home, notably higher inflation? Now, it hasn't cracked so much where no one is really saying this out in the open in terms of the heads of state, but obviously these are questions they are dealing with, and a lot of them, like Poland, has parliamentary elections coming up. So these are concerns that they have. But at the moment, they still want to make sure that they are projecting a united front behind Kyiv.
Hey, mates, let's wrap it up. All of these guys are going to leave. New Yorkers get their Manhattan back. After they've gone and we sit here, can we say that this was a successful UN General Assembly? Did things get done here?
I think it depends on what part of the region we're talking about. Was it successful in the sense that we did have a Netanyahu-Biden meeting that talked about potential normalization between Saudi Arabia and Israel, which Mohammed bin Salman, the crown prince, spoke about with Fox News last night? I would say for the U.S. administration, that is quite successful. Did Zelensky make his points? Yes, but at the same time, the only permanent member of the Security Council that showed up to the UN was Joe Biden.
AMH, thank you. Wonderful work over the last couple of days. Bloomberg's Anne-Marie out of New York this week for the UN General Assembly. On the Bank of England rate decision, Kit Jukes of SocGen with us around the table here in London on the Bank of England and a certain North London derby taking place this Sunday. Equity futures, session lows from London. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Equity session lows were shaping up as follows. We're down by 0.8% on the S&P 500. On the Nasdaq, we're negative by more than 1 full percentage point. Losses yesterday, negative follow through blame the bond market, blame Chairman Powell. In the bond market right now, the 2-year pushing 520 early this morning. New cycle highs in the last 24 hours, currently 515.88, pulling back by a couple of basis points on a 2-year. On a 10-year, just amazing to see this. A 10-year getting into the 440s after we heard BMO say the 10-year was a screaming buy. Morgan Stanley thinks we can break below 4%. Wells Fargo, we're talking up 350 on a 10-year, and yields keep pushing higher by another 3 basis points this morning. Lisa, on a 30-year, similar move. This time, we're pushing 450 on a 30-year in America.
I did catch in the corner of my eye Bob Michael the other day, and I asked him, are you still at 3% across the curve? And he's like, yeah, you know, this is just temporary. And you have to wonder at some point, when is it not temporary anymore? Not just for him, but for all of the people out there who've been going into duration saying, now's a great time to pick up yield. Why not?
Yields up, stocks down, dollar stronger. The euro looks like this, 106.38, negative 0.2%. Sterling at the moment, 122.55. We're negative there by almost 0.75% on the pound after the Bank of England TK leaves things unchanged.
Well, they leave it unchanged. There's a lot going on here. And the focus, particularly for the American audience, is the dissent, the split that's available there. It is like the Supreme Court decision, John. It's a 5-4 decision.
It's a 5-4 split on a 9-person MPC. Under surveillance this morning, that Bank of England split, following the Fed's footsteps, leaving rates unchanged at their meeting this morning. But as TK mentioned, a 5-4 split. 4 voters on the MPC still pushing for another hike. This ends a series of 14 successive interest rate hikes that started all the way back in December of 2021. I remember the conversation. I had the day off work. Bramo called me live on TV, got me to work because I said it was year over, thinking the Bank of England weren't going to go just yet. They started. And I said on the phone, I remember at the time, what's important here, Bramo, is how far they go.
Exactly.
And they kept going.
Exactly. Further than anyone had expected.
Yeah, big time.
And here we are. And so now, really, the key question is, can they pause, right? Is this a pause before another hike, or is this a pause before cuts? And that's really the question over at the Fed. And it's also the question at the Bank of England.
The mistake is to compartmentalize this into the United Kingdom. For our American audience waking up, you can poll Bank of England, and dare I say, John, Bank of Japan tomorrow, right over and synthesize it into the American rate market. And we see it in equities as well. VIX out through 16 and NASDAQ down a stick.
BOJ, next up tomorrow. Let's get you the update on the latest with the strikes. Stellantis proposing a new contract to the United Auto Workers. The deal offering a similar price increase and failing to give workers the clear vision of the future they are seeking. This all according to a union negotiator. The union is set to hold a Facebook Live event at 10 a.m. tomorrow morning, where it's expected to announce whether more plants will join the strike. And ultimately, this is going to be down to whether we can make some progress between now, Lisa, and then.
What does progress mean? I think you asked that a couple of days ago, and the answer is we don't know, but it has more to do, like Tom said, than just about money. This is about what products they're going to make. There was one union leader who was in the picket line who said the holdup is product. They didn't want to line up products for our plants for the future. How much is this direct repudiation of electric vehicle manufacturing and the percentage of jobs for that area that are unionized?
John, I'm colored by the massive EV debate in London this morning. It is front and center in the United Kingdom. And I underplayed that, and I was wrong. I think this EV discussion with this strike action is tangible.
The criticism of Sunak, the British Prime Minister, sounds like the following: that you're not giving businesses certainty, you're pushing out deadlines from 2030 to 2035 on phasing out the internal combustion engine and moving towards EVs. I think if you wanted to compliment the Prime Minister, he's being somewhat realistic about how quickly we can make this transition and how many people in countries like the UK, the United States for that matter as well, can actually afford this transition and how they're going to finance it. Particularly, Tom, when we're looking at a bond market like the one we're looking at this morning.
Right.
It's not as if this country right now can afford massive projects, is it?
My amateur take on this is you're precisely right. It's not a change in policy. It's an extension of the timeline.
Final story. House Speaker Kevin McCarthy winning the support of a few Republican hardliners as he looks to pass a short-term spending bill and avoid a government shutdown. McCarthy's still short of the votes needed to pass the Republican-only spending measure, which would still need to go to the Democrat-controlled Senate floor for approval. Lisa, as I read this, you're shaking your head. I think you can hear it in my voice. I can't believe we're doing this again. But ultimately, we're going to keep doing this, aren't we?
We are going to keep doing this, and as I was reading the details, I don't see how we avoid a shutdown. I really have no clue how we do that, because right now Kevin McCarthy has to wrangle all of the members in the Republican Party in the House, other than 4. He can afford to lose 4, and 2 of them are basically die-hard, shut down the government until we pass 12 separate spending bills, which is just an improbability. So it's a very difficult thing to see how we avoid this, and what the consequences are, I don't know.
We have the advantages of Anne-Marie Horton, chief shutdown correspondent in Washington. And
I just drank out of your cup on accident. What is that?
What was it? Tang. It's Tang Light. We had to import it. They don't sell Tang in the United Kingdom, so we had to bring it in.
I was expecting to get
record
like
it over.
water.
No, it's Tang Light. Yeah, it's
you
good.
don't usually have the same color cup as me.
It gives you energy. Right now, the interview of the day, this is a scheduled 6-7 minute interview. It ought to be 2 hours. Kit Chooks joins us, chief foreign exchange strategist at Societe Generale, and he led his research note today with what I was looking at early this morning, and that is the change up there. And the change is a U.S. real yield back to where it was in late winter of 2008. Kit, things are moving. Where are we going to be a month from now? Where are we going to be 3 months from now?
Left to itself, and I think in 3 months' time we're going to have potentially still higher real yields in the U.S. keeping on this going. It's going to stop at some point. I mean, part of the discussion is the political one, right? The big difference between the United States and Europe is that we're all raising rates because we have an inflation problem, but we have to tighten fiscal policy. John just said it. We can't spend this money. We spend so much money on COVID, a war in Ukraine. We have no money, and so we're in a difficult place. The United States can spend money because it's the United States, unless the politics says it can't. So as long as the politics lets the U.S. be exceptional, you can have higher yields and a stronger dollar as far as it goes.
What we've seen in the last 48 hours, and as John mentions, Bank of Japan has a hat trick tomorrow. Do we see, with what's moving, yen goes through 148, 149, weaker yen, where all of a sudden the Bank of Japan is overcome by Powell and Bailey events?
They have to do something extraordinary at the Bank of Japan to stand in the way of this tide of rising yields in the U.S. So they'll have to raise rates or intervene. Jawboning is not going to get us much further than we are today.
So no change at the Federal Reserve, no change at the Bank of England. Are we expecting any changes from the BOJ? Not tomorrow, but this year.
No, he hinted at them. I heard someone else on the Bank of Japan board sort of row that back a little bit and saying he was talking to the foreign exchange market. They can't just talk to the foreign exchange market. They have to decide what they want to do with monetary policy, and it's a tough decision given their challenge. But this is so like a baby 1984, 85. I mean, it's all somewhere in there. If you can imagine,
for those who were babies in the mid-80s, Kit, can you explain what a baby 1984, 85 is?
I don't want to say that Jay Powell is Paul Volcker, and I don't want to say that Joe Biden is Ronald Reagan, but it's this ability to push the dollar higher than you could imagine. I was in my first job. Everything I thought about fair value for currencies, anything I'd learned in school, was blown out of the water before we got to Plaza. This can, trying to guess how far you can go at the sort of the pointy end of this piece of the cycle is really crazy.
So we don't know how far you can go, but we do know that some people are expecting, including JP Morgan's chief equity strategist over in Japan, they expect that the Bank of Japan will leave yield curve control next year, end negative rates, possibly by even later this year, if not early next year. Do we have an understanding of what the knock-on effects would be, not just from a currency perspective, but from a rate regime globally?
I think generally, they're so far behind everybody else that it's possible that it doesn't completely rock all the boats in the world. Right? This is a country where what that would do would start the process of Japanese investors buying JGBs again at higher yields instead of buying foreign assets. So it has a knock-on effect in the currency market, but they're not as big or as important as a player on a flow basis as they were 30 years ago. So it doesn't have to be, so it doesn't necessarily have to start a new, long, dramatic rise in global bond yields. But it causes waves because it tightens global monetary policy one step beyond what we've been seeing. And if you forced the Chinese to follow at some point, if they don't want the yuan to weaken, you can take this further. So it all rolls it down.
We're talking about a stronger dollar and how far that can go at a time where, as you were saying, the U.S. can be exceptional as long as lawmakers allow it to be so. How far can it go before it becomes substantially problematic for the rest of the world, in particular the UK, in particular Europe?
I think it's already problematic. I mean, you already see the Chinese who usually have complete control over things like their currency don't like the yuan weakness. The Japanese don't like it there. If you send U.S. yields higher and the dollar stronger, you could reverse some of the wonderful progress that's been made in Latin America in the last few years. So we're not far away from people howling about what this is doing. I mean, this is the problem. A stronger dollar will be much less damaging to the United States in the short term than it is to other people.
To me, what's really important here is the analysis of a difference between Section 14 at Emirates versus Section 60. I mean, you really need the elevation to see the Spurs on, was it Saturday or Sunday, John? Do you need the elevation of a Section 60, or should you go lower at Section 14?
It's a bit noisier downstairs, but I like to be able to see both ends of the pitch at the same time. I like to look diagonally across the pitch so that I can see everything.
This is when the Spurs beat Arsenal.
Then I'm very glad I've hidden away up in the nice seats.
Kit and I have watched the North London derby together many years ago. I think maybe 9 years ago, something like that, maybe 10 years ago. It was a good time. I think Arsenal absolutely crushed Tottenham back then. I think Theo Walcott was there.
He was still there.
Yeah.
Harry Kane was there as well.
How come Arsenal has U.S. ownership that's successful and other selected teams do not?
Kit, do you want to explain that? When you say selected teams, are you saying Chelsea?
I'm going to go with it took a while for them to get good at it, but that they have a heritage and a history in owning football clubs in that family.
Yeah, and the Los Angeles Rams or whatever the Rams are.
We're talking about here,
What about the Saudi money? I mean, the petrodollar money coming in. Is that going to change Arsenal and the rest of the sport?
It changes all sports everywhere to have Saudi money coming in until the thing levels itself out. And so the problem with sport, I mean, in that sense, there's an enormous amount of money that changes it for the average fan, recognizes the fact that the economics of sport has changed, which we could talk about for a whole day, and does a bunch of things to, in the short term, to the politicization of sport, which again, is an interesting sort of thing. But at Arsenal, frankly, the change of manager was possibly the big change we made.
Yeah, Mikel Arteta. If you are just tuning in, welcome to the program. Equity futures right now, negative by 0.8%. Yields are a little bit higher by 3 basis points to about 443.94. And if you want to talk about football, there's a big game coming up on Sunday, big North London derby, Tom.
It's a North London derby. I've never witnessed one as well. And, I mean, if I was just to the left of the director's section at Arsenal, that would, be
trying to get tickets still, because this has lobbying for tickets, Ramo. Is this it?
That's the reason why we brought Kit on, basically, entirely to see if you had tickets that you wanted to sell or just give.
You don't sell these tickets, they're willed to you.
They're willed to you.
They're willed to you.
They're really like in the...
So we caught up with Daniel Levy yesterday, the Tottenham chairman. He's been there for more than 20 years, longest serving chairman in the Premier League. Only one big trophy to speak of, if you want to call it big, was back in 2008. Tons of pressure. There's a different mood around this club now, TK, a different mood with the appointment of Big Ange. I don't know if you've heard the song, but you should listen to the song on YouTube. It's a great song. This was a man under a terrific amount of pressure. And I think what's amazing is they let go of their star player this summer, and people reflect on the summer transfer window as a success, even though Harry Kane has gone to Bayern Munich.
For our American audience, I have fun with this. I'm the dummy on the desk. And I'll tell you, John, what's so exciting to me is to see the Tots blow it up in a lot of new players. You don't see that in American sports.
We talk a bit about management decisions previously and what went wrong, what he's more comfortable with now. You mentioned Saudi money, the pressure with the Saudis coming into the business as well, and how sustainable this business is at Tottenham.
The Tots have seats at Emirates too, so maybe if I call it Mr. Levy and his team,
You think there might be at the game on
Sunday?
We can
work it both ways, John.
I'll bring you some of our conversation with Daniel Levy, the chairman of Tottenham, up next.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Live from London, welcome to the programme. As we mentioned, the Tottenham chairman, Daniel Levy, revealing he'd be open to selling a stake in the club, quote, for the right person. I sat down with Levy for a wide-ranging interview on the club, including the recent sale of star Harry Kane to Bayern Munich. Take a listen.
So Harry was willing to stay, but he wasn't willing this summer to sign a new contract. He didn't say that to me that he wanted to leave. He didn't say that he would never sign a new contract, but he wouldn't commit this summer. And of course, we were in a very difficult position, had 1 year on his contract. And as a club, as I said, we're self-sufficient. We couldn't live in a dream that he would sign a contract. We had no guarantee, and therefore, when Bayern Munich came along, he was willing to go to Bayern Munich, and we agreed a deal.
You've since disclosed there is a buyback clause. That's getting a lot of attention and a lot of fans excited. Can we talk about the terms of that buyback clause? What is it?
If I'm honest, I think the actual precise detail of the contract with Bayern Munich should remain confidential. All I would say is if Harry one day wants to come back to the Premier League and he wants to come to Tottenham, we would have the ability to purchase him.
We've talked a lot about Saudi Arabia and the disruption in this summer transfer window, not just for English football, but for the whole of European football. Are you getting players knocking the door now saying, I've seen Neymar's contract in the newspaper and I want a slice of that? Has this changed things for you?
I think you have to look at the Saudi Arabia situation as, it gave a huge influx of money into the market. The market is particularly tough outside of the UK at the moment. And I don't see that what's happening in Saudi Arabia is going to have any direct bearing in terms of player contracts in Europe.
What do you expect it will change?
Well, it's another market for players to look to. Not every player will want to go to Saudi Arabia, but just as not every player wants to go to Germany or France or wherever.
Joe Lewis has got his own legal problems. He's transferred his holding of the football club to Family Trust. We understand that dynamic and how things have changed in the last couple of years on that front. Technically, that means you no longer have that big billionaire backer. Do you need one to succeed? Is that something that Tottenham needs?
Well, firstly, the ownership of Tottenham has been of no relevance to the operations of Tottenham for the last 20 plus years. It's always been self-sufficient. As far as very wealthy people owning football clubs, as I said, the new rules now are going to be engineered to such an extent that hopefully you don't need to be a very wealthy owner in order to have a successful club.
Would you be open to selling a stake?
My answer to that question has always been the same for 23 years. We have 30,000 shareholders who own approximately 13.5%. We run this club as if it's a public company. If anyone wants to make a serious proposition to the board of Tottenham, we will consider it along with our advisors. And if we felt it was in the interest of the club, we would be open to anything.
Has anyone made an offer?
Over the years, many people have made offers, but there's never been an offer that's been...
Well, give us an idea of what those offers have looked like. Where have they come from?
All parts of the world. the Far East, the Middle East, America, but nothing has been put on our table that we felt has been in the interest of shareholders.
The stadium's been a big project for you, and clearly that's right for the club, and other people are starting to copy you as well. How big of an initiative has that been for Tottenham Football Club, and how do you think it's going to really underpin the success in not just years to come, but potentially decades?
I think people don't realise how big a project building a stadium is. You know, that project took us probably about 17, 18 years from start to finish. I think you've got to take a very, very long-term view. I think that it obviously has a major impact on the club, positive and negative, because you don't build a stadium for nothing.
A multi-purpose stadium as well. It's not just about football anymore, is it? It's music, concerts. It's about everything else and all above.
Well, that was done for two reasons. One is, when you look at the cost of building a stadium, you're talking about such huge sums of money. In our case, it was £1.25 billion. I think today it would be over £2 billion.
Wow.
And you have to find ways of paying for that asset. And just having football games is not enough of income to
So what does music bring in, Daniel? Give me an idea of what a Taylor Swift, Beyonce music concert brings in for Tottenham. How much money can you make from something like that?
Well, every concert's different. So it's not just concerts, it's boxing, rugby, all sorts of events. You're not going to justify spending the money by all those other events. What they do, though, they make a contribution to the capital cost. I would say that, over a full year, we may make 20, 30 million pounds of additional revenue as a result of it.
And what's the gate receipts look like just in terms of football over a season? How does that compare? How does that stack up?
Well, our gate receipts now are over £100 million.
Big Ange has come after Antonio Conte and Jose Mourinho. Can we talk about dealing with difficult characters? What was it like dealing with Antonio Conte near the end?
I had a good relationship with both Jose and Antonio. They're different, and as I said to my fan forum last night, I said to them, I made a mistake. Right? They are great managers. They were just not right for this club. And the way they want to win is different, really, for how we need to win.
What does that mean? They're proven winners. They've won before. What does that mean?
I think there's a couple of things. I think our style of football that our fans crave for is we want attacking football. And if that means winning 4-3, then so be it. Whereas I think their style of football is, they don't mind being defensive and winning 1-0. And we were in a situation where we were so desperate to win. I think at that moment in time, when I go back, 4 or 5 years ago, I think we would have taken any way of winning. But we didn't win. And therefore, when you don't win, you get a very disgruntled fan base with our fans.
Where did the pressure come from to begin with to hire names like that? I was listening to the recent fan forum you did, and you mentioned that certain players wanted a certain kind of manager. You alluded to that. I'm paraphrasing to some extent. Were there certain players that wanted that kind of name? Jose Mourinho and Antonio Conte? Do they come and knock the door and ask for that?
And it wasn't about the name. It was about they wanted to win, just as much as I did. And then we'd come so close with Maurizio, who was a great manager, and he did fantastic things for this football club. And we got frustrated, and I think we went through a phase where we said, well, let's try something different. And it didn't work.
Define success for this season. Let's finish there. What is success for you this year?
That's a difficult one for me to answer, because I think I'd be putting unfair pressure on my new coach. Honestly, I think for us, though, we want to play football where we're entertained. We want to come to a game where we're looking forward to coming to a game, where we believe we have a really good chance of winning. We just want to entertain our fans.
Entertain and win?
Of course, win, but win with style.
Daniel Levy, the Tottenham chairman, will put out the full conversation over the next week or so, but a pretty extensive conversation with the longest-serving chairman of a Premier League football club, Tom.
Absolutely brilliant. There's so many ways to go here, and we don't have the time to do it, John. But I'm going to compare and contrast them with the Toronto Maple Leafs, where they really don't have to win. And you nailed that at the end of that interview, where he said he wants to entertain people. That's why Harry Kane left. It's not entertainment.
He has not been a popular chairman over the years. More popular now based on his appointment of this new manager. It's a moment in that conversation where I asked him, what is it like to hear Levy out in the stadium when a certain section of the fans are cheering that? And Tom, that is a fan first and foremost before being the chairman of the football club. And he said it's not nice when your family hears it. And you're sitting there and a certain section of the fans are singing that
They had to go to the Bank of England off of COVID to get a loan to get through COVID. They finance this thing through Bank of America, Merrill Lynch, 1.2 billion all in pounds to build that palace. I've had the honor of being there. Thank you, Spurs. Great. Other sports teams are always looking for a bailout. Can you help us? London, can you build the stadium with this, Margaret Thatcher, can you? No, they did it by themselves. It's a triumph.
So it's a multi-purpose stadium as well, which other clubs are trying to replicate, including Real Madrid. And Lisa, when he's going through the gate revenue there, you're looking at 100 million sterling per season now, gate receipts for football, 30 million for concerts, because you have the ability to have that retractable football pitch and then have the music concerts there within the season.
What I paid for the little meat pie,
that's contributing to the overall revenue.
It was outrageous.
But that's a good point about just the idea. He said it's supplemental when it comes to their income, but it's a pretty big supplement, and it raises this question of sports as entertainment almost first and foremost above winning. And I point to a couple of days ago, the Saudi Soccer League, which paid so much for all of their stars, is drawing fewer fans than Ryan Reynolds' Wrexham.
I saw that.
Which to me just highlights where we are.
Look for this entire interview, John. I love that. Can you just explain to Levy in your thank you note, it's not entertainment. Would you windham it?
From a Tottenham fan. Open to a stake sale. Some news in that conversation too. Coming up next, Jim Bullard of the St. Louis Fed, formerly of, sitting down with Mike.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, Our average restaurant now does about over $1 million per restaurant in digital sales.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
We intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
We're running strong growth. We're running inflation that's above target, so it makes sense to guide towards higher for longer.
There is a concern on the other side of this that they're going to need a higher neutral rate.
The economy has changed since the shutdown restart, and the Federal Reserve is still struggling to come to grips with that.
The Fed delivered exactly what they wanted to, provide a hawkish sap that allows them to speak more dovishly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene from London. An extraordinary set of days, a 48 hours of history and monetary theory. The Bank of England, in violent dissent, says we will not raise rates. Less violent, Jerome Powell, everybody in agreement. We are going to stand still, unlike what Jim Bullard would do. Jim Bullard would have raised rates, John.
I tell you what, Tom, I cannot wait for this conversation with Jim Bullard. Unleashed now, he's left the Federal Reserve. Not like he needed unleashing anyway, sitting down with Mike McKee in a couple of minutes' time. I want his view on one thing, the forecast. Because you remember that almost protest dot at the bottom of the S&P dot plot many years ago? I'd love to hear what he's got to say on the median projection from this Federal Reserve. Because if you can ascribe a narrative to that median projection, to use some of Chairman Powell's language, it screams soft landing. But the chairman himself says, Lisa, that's not a baseline, that's the objective. So I'm trying to work out, what's the forecast?
And if they can't forecast anything with any accuracy, then what are they doing? Are they having some sort of thesis about what is a worse kind of prognostication, inflation or some sort of recession? They are saying the words that they care more about inflation, but their actions are leaving some people with a lot of questions.
On radio and television, Global Wall Street, stay with us right now. McKee with Bullard here in a moment. And John, what I would say is the gentleman from Indiana University, he is at Purdue in West Lafayette. That's un-American right there. I don't know how that works. The red of Indiana University over boiling it up in Purdue. I don't know.
So boiler up is Purdue.
Boiler up is Purdue. And Indiana University is you win at basketball.
He's not Purdue.
He went to school at Indiana.
And he's now at Purdue.
And he's migrated to Purdue,
so
where he's boilering up. That's, I think, how
should have figured this out in a commercial break, shouldn't we? Okay.
The heart of the matter is this is the one guy who said we should not fear high interest rates. Bullard says we're not going to roll up and die in a high interest rate regime. And right now we're at the cusp of that.
And his old colleague, Governor Waller, now on the Board of Governors of the Federal Reserve, was the one who was really offering up the idea a year or so ago that perhaps we can get inflation down without too much pain in the labor market. Based on the projections we've seen yesterday, that's almost the consensus view at the moment.
Now, I'm going to continue that. Tom Melzer inventing the modern St. Louis Fed. And Lisa, this is research-based. Do your work, roll up your sleeves, look at the real economy out at the St. Louis Fed, and that's the heritage of Jim Bullard.
It's hard enough to understand what it means to raise rates to a certain level for the broader economy. What I'm curious to hear from him is when you keep them there for that long, what you understand to be the implications when the implications and the effects have been so delayed with rates that have been so low effectively for so many borrowers.
John, speed data check. I'm going to look at the real yield, the 10-year real yield out 2.08%.
The nominal yield's 4.45 on a 10-year yields up by 4 basis points. It's absolutely amazing to see the Treasury curve right now. The 30-year just short of 4.50. The 2-year, Tom, 5.17. Yields just about unchanged, but basically at cycle highs in the last 24 hours. Amazing to see.
And now, in conversation with James Bullard, the former St. Louis Fed president, our Michael McKee.
Well, thank you all very much, and we'd like to thank Jim Bullard for coming in and joining us today. I would have called you Mr. President, but now, what do we call you? Dean Bullard, I guess.
You can call me Jim.
Well, Jim is the Dean of the Daniels School of Business now at Purdue University, and we thank you for joining us today. I want to start with the dot plot. I think we have a picture of the dot plot that we can put up. For those of you on radio, you can look up the dot plot on the Fed's website. But basically, in June, the last time we put out a forecast, there was one lonely dot way at the top saying 6.25%. You left. That dot's gone. How would you have voted if you were there yesterday?
I thought this was a pretty good decision on the part of the Fed here. The higher for longer message, I think, is consistent with the rhetoric we've been hearing from the committee. Earlier this year, there was widespread prediction that there would be a recession in the second half of 2023. That recession isn't materializing. So to the extent you thought that a recession would produce extra downward pressure on inflation, that had to be taken back out. So you ended up with a higher for longer message here. I think that makes a lot of sense.
So we don't need higher rates at this point?
Well, the committee left the additional rate hike this year in the dot plot. I think that may be a good thing to do as insurance to make sure that core inflation especially continues to come down at an appropriate pace so that the committee can get back to 2% inflation in a reasonable time frame. I think the risks are building that inflation could hang up at a higher level or even go higher based on the idea of a reacceleration in the U.S. economy. So you have to take account of that probability when you're making policy. I think the committee has done that here.
Well, one of the interesting questions is about the forecast. John was just talking about it. You've got the Fed saying their growth forecast has doubled, their unemployment forecast has been cut significantly, and yet they're also predicting that PCE core inflation is going to go down. How does that work?
Well, I think you will get disinflation with, that's the base case. The question is, how fast will that disinflation occur? If it's a very slow disinflation, you're going to want to keep policy rate higher in order to put more pressure on so you get back to 2% sooner. And there's a little bit of probability that inflation would just stall out completely at the current levels, which would be unacceptable. It's, core inflation has a handle, depending on how you measure it, in the 4 range is still double or more than double the Fed's target. So you've got a long ways to go here, and I think you want insurance on the side of making sure that you get back to 2% inflation. On the real side of the economy, things look pretty good. You've got some reacceleration in the third quarter here. It looks like we've talked about it before, and unemployment still with the 3 handle looking very good.
Jay Powell wouldn't say the words, but it looks like the forecast is saying soft landing.
Yeah, I think the prospects for a soft landing are very good, but you haven't landed until you get inflation back to 2%, so you're only partway through this process, but prospects are looking good.
If that's the case, then the question becomes higher for longer. How much longer? The Fed took away 50 basis points of cuts from their forecast for next year. But how long do you think you need to lean against inflation to have an effect?
Well, there'll be data dependent on that, but I think this idea that you'd have 5% policy rate or higher over the next 18 months or so, I think that's significant and shows you resolve on the part of Chair Powell and the rest of the committee to get inflation lower. So that's quite a while. I think once you get out beyond that, the end of 24, you get into 2025, nobody knows at this point.
Well, that raises the question of lags and how long the lags might be if it takes 18 months to bring it down.
Yeah, I don't know. I haven't liked the long and variable lags story for the modern era as much. I think a lot of the transmission of monetary policy occurs pretty rapidly through financial markets in a way that was not the case in the 1960s and 50s, that when Friedman was talking about long and variable lags. So I think the economy has changed. Information moves much faster. Decisions are made much faster than they would have been, and the world's more forward-looking than they would have been in the 60s and 50s. So I think you should look for impact today, or more impact today than you would have in that earlier era. And so by keeping the policy rate high right now, I think you can get disinflation to happen now. It's not really so much 2 years from now.
Well, what kind of economy will we have 2 years from now? We get the pandemic distortions in the economy out. Supply and demand maybe come back into better balance. But do we have a new economy? Do we have an old economy? Where do you think neutral is? Are we going back into a rate regime that is higher than we were used to in the 2000s?
Yeah, I think, and we've talked about it before, but one of the historical examples that you want to look at here is the 1994 tightening cycle, which was not as big as this one, but set up the U.S. economy for a stellar second half of the 1990s, one of the best periods in U.S. macroeconomic history. So if you can get inflation to continue to come down here with a pretty strong economy, you could set the economy up for a productivity boom and a very strong period in the 2020s here. So hopefully that's what will happen. I think we're only partway through that process at this point. But if you really do get a soft landing, then you could look at a period of good growth, strong labor markets, high productivity growth. So I'm not saying that, that's definitely going to happen, but that's certainly one of the possibilities.
What happens, we'll have only about one question left here, but what happens with the labor market going forward? Are we going to see ongoing wage pressures because there just aren't enough people to fill the jobs out there?
Yeah, I think labor supply is somewhat diminished from where it would have been pre-pandemic or earlier. I think you have older workers less willing to come back into the workforce, so they're kind of a marginal worker type, and they're not coming in as much. Their nest eggs are pretty robust here with high housing prices and relatively high equity prices. So I also think daycare has been kind of decimated by the pandemic, so this has changed arrangements for parents with young children, and so you just have a subdued labor supply compared to what you would have had pre-pandemic, and this is leading to continued tightness in the labor market.
Well, we thank you for coming in. We're going to send you back now to Purdue to graduate some more engineers so we can fill those empty labor slots. Jim Bullard, thank you for joining us today. We'll send it back to you in London.
Hey, Mike, can you just squeeze one extra question in? Can you ask Jim, if there's no value in the forecast, why are they still producing them after that performance from Chairman Powell yesterday? Can you ask him quickly, Mike?
Sure. John is asking, if there's no value in the forecast, then why do they keep producing them?
Well, it's what we do. I think, forecasts are useful, but only up to a point. There's a certain amount of ambient noise in the economy. You can't get away from that. You can't live with them and you can't live without them, I guess is the way you would say that.
All right. Thank you very much, John. I hope that answers your question.
Thanks, Mike. Just about. Mike, appreciate it, buddy. Fantastic work. Just one of the best, as always, and brilliant performance in the news conference from Mike McKee yesterday as well, sitting down with the former St. Louis Fed President, Jim Bullard. TK, your view on that one?
My view on this one is this guy's courageous, and there's something about the different Fed presidents and their geographies. This is a guy steeped in the real economy, and he understands that if we have higher rates, and the real rate moments ago going to 2.09%, we will survive. There's a lot of OMG, we're all going to die. Bullard's not on that team.
There was a standout there as well, Bramo, not buying the long variable lags argument at all.
How did you read my mind? That's what I was thinking about. I was just like, I mean, seriously, that's what I was thinking about. Other people would disagree. He's saying it has an immediate effect.
Ed Morse City, coming up next from London. Good morning.
markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Today, surveillance is live from London for the Bloomberg Global Credit Forum. After a decade of cheap credit, Tom, John, and Lisa address the risks in today's debt markets and the opportunities ahead. Tune in at 10 a.m. Eastern, 3 p.m. London time for the special episode featuring an interview with Apollo's Jim Zelter.
I got my hands full.
Only on Bloomberg. Context changes everything.
An average of 92 does allow oil prices to go to 100. We're putting out a piece later today, which is calling for $100 by Halloween for Brent. And again, this is just a trajectory. And at this point, look, of course, it's a short-term thing, right? I'm not saying it's going to average above 100, but could it go to $100 for a bit? Absolutely, yes.
Triple digits by Halloween. That was the call from Amrita Sen, founder and director of research of Energy Aspects. Brent crude briefly through 95, back it away, 93.43 on the screen right now. We're down about 0.1%. WTI crude, for what it's worth, totally unchanged. Someone who's taken the other side of this, Ed Morse of Citi, he's going to be joining us next. I do want to touch on the bond market. Bonds having a difficult day at the long end, of 5 basis points on a 10-year in the US. In the UK, up by almost 11 basis points now on a UK 10-year gilt yield. The 10-year in America, 446. The 30-year, very briefly, through 450. Lisa, these are big moves in this bond market.
And they're being driven by the real yields. I keep wondering what the shift has been, and if people are getting their head around lower for or higher for longer, I should say, versus lower for longer 10 years ago. There is a question about whether this is a tacit acceptance of a higher inflation rate, of a higher benchmark neutral interest rate, and whether that's feeding out into markets more broadly.
And you bring it right over to the real economy, as Jim Bullard was doing there, and you bring it over to the idea of recession fears. I'm not looking for recession fears in the U.S., but we've had a number of guests today modeling a German reality over to a United Kingdom recession, and then you go on there around the world when you see elevated real yields.
I know you're itching to do this. Have you got the orb ready?
We got the orb ready, folks. We're right here. We demanded
orb.
this when we designed the set here.
Does anyone remember what the orb was?
This is the Saudi Arabia. There it is. There, nice wide shot.
Thank you. With the Saudi royals.
There, that's perfect here. We've got the orb here.
What was that?
I have no idea.
I still don't know.
Stretch it out, Bramo. You can stretch it out.
Yeah.
We
Nice.
do this
Drop over,
going
pull over
into
everything.
What happens?
an expert on Saudi Arabia. Edward Morris holds court at Citigroup, global head of commodity research, and always takes a geopolitical look. He has been brilliant over the last 2 years of saying, everyone calm down. We're going to see lower oil prices, more sustained $70, $80 prices, and then things have changed. Ed Morris, what changed to elevate oil to $100 a barrel?
Well, it's quite simple. A bunch of countries that had a lot of surplus capacity decided to rein it in and pull back. If you look at the oil market, there's no more oversupplied market in the world based on supply and demand. But those that have the supply have pulled it back, and they pulled it back because they didn't like the revenue that they were getting. So there's a big difference between oil and copper and oil and a lot of other commodities in terms of the fundamental availability of supply in that market.
Right. We were making fun and jest of the orb, and that is, of course, President Trump visiting Saudi Arabia. What is the U.S. relationship now with oil-producing Saudi Arabia? Has it changed?
Yes, it certainly has changed, and it's changed dramatically. Part of the change relates to the geopolitics of the area. We saw one element of the change at the G20 meeting when a number of countries that include India, include countries in the Middle East, including Israel, include the European Union, decided to build physical, their own Belt and Road Initiative. And they excluded China and they excluded Russia from it. But the U.S. is very much a part of it. We're talking about Westinghouse technology going into Saudi nuclear power. We're talking about guarantee on the security side. We're talking about oil markets and common and differences among them. But it is a different relationship from the more sour one with which the Biden administration began itself in office.
Ed, earlier in the year, you were the lone caller for some sort of lower oil price, and you were absolutely correct. Now you're coming out and pushing against people who are really upgrading their forecasts for oil in light of some of the Saudi Arabian production cuts. How can you be so sure this time around if this is essentially Saudi Arabia searching for $90 to $100 a barrel of oil for their financial well-being?
Sure. Well, I think there are 3 or 4 factors that just overwhelm it. One of them happens to be what we call the fragile 5 countries. They are Iran, Iraq, Libya, Nigeria, and Venezuela. They're countries that in 1998 were growing really rapidly in their production. People thought they were going to be adding 1 million barrels a day a year. 5 years after 1998, they were producing less than they were in 98. The world scrambled to find new supply, and the price of oil went up. These countries are adding supply in surprising ways. If you look at June versus June, 2023 versus 2022, these countries added over 1 million barrels a day to oil supply. If you look at where they are now and just look at Iran and Iraq, the chances are that the 2 of them together are going to be adding close to 1 million barrels a day of production between now and a year from now. That big change, and the change is not just among the 2 of them. If you look at Nigeria since the recent elections, they went from the monthly average of 1 to 1.2 million barrels a day to now 1.5 to 1.7 million barrels a day. They're at 1.7 right now. So those fragile 5 countries are not under the control of the leadership of OPEC Plus, and they intend to put more oil in the market. A second really massive factor is China. China has, yes, an economy that is more commodity dependent than any other country in the world. But what China has done since the great financial crisis, and done it consistently, is buy low and sell high. So they accumulate an incredible amount of inventory. The inventory that they've grown has been from just under 1 billion barrels at the beginning of the pandemic, not very long ago, to 1.4 billion barrels in our judgment right now, with a capacity to go to 2 billion barrels. 1.4 billion means they have 130 or 140 days of forward supply in their inventory system. The IEA, in its wisdom, says 90 days of forward supply is ample. So they're in a position to do what they're now doing, buying less oil in the market. They had 4 months in which they were buying 12.5 million barrels a day. They have 4.5 million of their own production. They had months in which they had 17 million of supply. They don't refine more than 14.8, 14.9. They put it in inventory. And now that prices are very high, what are they doing? They're selling, and they're selling incrementally an awful lot of diesel into a market which is diesel, poor, and where diesel cracks are overwhelming. So they're making money by not buying and by selling high on the product side. And then we still have ample production growth from non-OPEC. Our judgment is that demand is going to be slow because of all the macroeconomic trends you guys have been talking about for the last 15 minutes. We don't think demand is going to be growing, more than 1.2 million maybe barrels a day next year. And non-OPEC alone can fill that without even thinking about the fragile 5 or what China is doing. So I think, the way we look at the trends, it's going to be a weaker market.
Just quickly here, Ed, in the interest of time, what you basically said is that China is building its own SPR that's much bigger than the U.S. as the U.S. was trading their own SPR. How much is Saudi Arabia going to keep production low simply because they know China is not going to be a big buyer?
I don't know. I don't know how to read the tea leaves on it. There was an article in Arab News involving a conversation between the Crown Prince and the Prime Minister of India at the G20 meeting. And the Crown Prince is quoted in a Saudi newspaper, therefore it's intentional, that if oil sustains above a certain level, they'll be putting more oil back in the market, or there are good chances of it. That was not an accidental story. So we don't know what the pressure point is. They like 90. They don't like 80 or 70 as much as they like 90, and they're fearful of what happens at 100.
Ed, thank you, sir, for the update off the desk over at Citi. Ed Morse there. Not as bullish as some. Not as bullish as Amrita Sen, that's for sure. Looking for triple-digit crude by Halloween. Brahma, we are pulling back to about 89.60. You just wonder how much this higher for longer message filters through the commodity market as well.
If you have money coming into real rates, are people going to want to buy and own physical product? That has been the big question.
Callum Pickering of Berenberg is joining us next. Big 24 hours for central banks. Another big 24 hours still to come. We've had the Federal Reserve and the Bank of England. It's the BOJ's turn tomorrow.
Parliament.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Economic data incoming, jobless claims about 20 seconds away. Going into it, what a move in the 8% on the Nasdaq, down by more than 1 full percentage point. Here's the why. Your wires in the bond market, yields a whole lot higher. Your 2-year through 5%, looking at 520. Wow. Your 10-year having a look at 450, up by 6 basis points to about 447. Gilt yields TK up by 11 basis points. With your jobless claims wow data, here's Mike McKee.
Jobless claims wow data is right, John. 201,000 jobless claims filed last week. That is an extraordinarily low number given the situation that we're in here. It looks like companies are just holding on to workers. 1,662,000 continuing claims, and that is lower than the previous week, but I don't have the revisions yet. Everybody trying to load up these numbers here. Here we go. Last week revised only by 1,000 to 221,000, so a drop of 20,000 in jobless claims, and last week's 1,683,000 goes to 662, so a big drop in continuing claims as well. Also mentioned the Philadelphia Fed business outlook is a bad number, negative 13.5, down from 12 the prior month. So business conditions in that area around the Philadelphia Fed not as good as they had been. One thing I would note here is that the United Auto Workers strike began last Friday, so there wouldn't be time for auto workers who are laid off to have filed. So next week you can start to expect some really distorted numbers in the jobless claims numbers. If you're on strike, you're not eligible, but if you are laid off because your plant's shut because some people are on strike, then you are eligible. So we can expect to see some filings for next week, guys. And so this 201 may be the last clean read we have in a while, but boy, it is a pretty low number.
Mike, Tom has questions. I just want to turn to the price action briefly. Session lows, down about 1% on the S&P, down by 1.3 on the Nasdaq, and cycle highs in the bond market. Can we just turn to the 10-year just briefly? The 10-year at the moment coming really, really close to 450. The 10-year, the higher the session, 448.20. At the moment, we're at 447.38. At the front end of the curve, we've seen new cycle highs earlier on this morning, pushing 520. Higher the session, 519.73. We're getting closer again, 518 on a 2-year this morning. TK, you raised what this might mean for foreign exchange. Well, I can tell you, if yields are higher like this, everything else is weaker against the dollar right now, including the euro. The euro drops to about 106.30. Tom, on that currency pair, negative about 0.3%.
Michael McKee, what's so important on this with your wonderful conversation with Dr. Bullard and also your wonderful conversation yesterday with Dr. Powell at the Fed? Mike McKee, is the Fed aware that these levels are getting back to, dare I say, 08, 07, 2006 levels?
Well, they are, and I think that's why you saw them go on hold for an indefinite period. My guess is that they don't raise rates again going forward. The Fed sees what's going on in the economy, and they've adjusted their forecasts, whether they're worth anything or not, as our discussion with Jim Bullard was about. But they're looking at an unemployment rate of 3.8% at the end of the year, which is historically very, very low. There's almost no comparison to how long we've been at that level so far in this recovery. So they know that there is a very strong economy out there, and their question has to be, is that going to produce additional inflation? They don't want to say the word soft landing because they don't want to jinx it or get the markets all in a roil, but they do anticipate a soft landing. But does that bring inflation, or do they need to keep pushing because inflation goes up?
Well, Mike, haven't they just told us, if those forecasts are worth something, haven't those forecasts just told us that actually it doesn't matter for price pressure? Can we really sit here and say that this labour market data has been de-emphasised by the Federal Reserve in the last 24 hours because they now believe, based on the median projection, you can get back to 2% without damaging the labour market at all? So the question I would ask, Mike, are they de-emphasising the importance of the labour market to overall price pressure based on what you saw in those forecasts yesterday?
You almost have to wonder, John, about that, but I would say they are not de-emphasizing it so much as accepting reality. They can't explain why, at this point, the labor market can be so tight and we don't get ongoing wage pressures. I mean, wages are still higher than they need to be, but they have come down. So what is going on around here? That is the question for them. The Phillips curve relationships they depend on don't seem to be holding. And so they're accepting reality, but I think that's one reason they are leaving in the idea of a possible rate increase by the end of the year, just in case they're wrong about that unemployment starts to get lower and push up wages again.
Michael McKee, thank you so much, and congratulations on that important interview with Mr. Bullard earlier today. It is a jumble today. You're really seeing it in the markets moving. It really sets up nicely our credit seminar with Apollo that you're going to see here later this afternoon.
Perfect timing for that.
We need to combine the belief here of what we see from the Bank of England into the Fed action yesterday. Caleb Pickering is more than qualified to do this, senior economist at Berenberg, sharing duties with Mickey Levy as well. And John, what's even more important is you and Caleb survived Thursday nights at the University of Warwick Student Union. I mean, both of you at different times
causing trouble.
You survived the party scene at the University of Warwick. Why don't you bring in your fellow colleague at work?
I'm so happy I've just got a quote ready to go from Andrew Hollenhorst over at Citi. Good morning to you, Callum. Good morning. This from Andrew. The Fed is projecting inflation to steadily cool while the labour market remains historically tight. But in Citi's view, a sustained imbalance in the labour market is more likely to keep inflation stuck above target. You kind of got to pick a side. Is it the Fed's projections, or are you with Citi on this one?
I'm actually with the Fed's projections, I've got to say. I'm fairly sanguine about this whole wage price spiral risk. Question is, do we trust our Phillips curve models? The conditionality for a wage price spiral is typically, and this is what we saw in the 1970s, inflation expectations are very high. We then factor that into our wage setting, that becomes embedded and self-fulfilling, and then you get the spiral effect. Inflation expectations are fairly well behaved for consumers, basically around the advanced world. It suggests to me we don't like the fact that we were poorer last year and we want some compensation for that. But if my inflation expectations are well anchored and monetary policy is tight, then with a lag, wages should follow inflation down. That's what we see in the US. It's what we should soon see in Europe.
So is the arch view here that the pandemic took us away from core theory, and now that we're beyond the pandemic, Phillips curve dynamics come back into play?
I think so. I think normal business cycle dynamics come back. The curious thing about the pandemic was that actually preceding the pandemic, fundamentals more or less looked fine, but we were in this chronic funk of sluggishness and pessimism. We locked the economy up, we juiced it, and we unleashed an almighty amount of economic energy, and things now start to look normal. And so in markets, we're saying all the time, what do these higher bond yields mean? Actually, from an economist perspective, we should say, why are bond yields rising? What if the world is just returning to normal? If that's the case, then these bond yields make sense.
But then why should unemployment rates rise, and why should you have that increasing slack in the labor market that would lead to wages not driving things higher, given the fact that if you just look at bond yields, you look at what we just got from jobless claims, what you see is what you get. We're seeing a lot of strength.
Well, I think the strength is actually the point. The strength is the reason for the higher bond yields. If we have higher bond yields because we've got less gas in the world and inflation is running high, that's a problem. That's a double whammy. But if higher interest rates are just telling you that the economy is strong, that's not a big deal. If we have rising unemployment, modestly rising unemployment in a growing economy, it could simply be that firms find it too expensive to hire. They can easily expand production through capital investment, and so they do that.
Do you buy into this whole idea that Jim Bullard was putting out there of the St. Louis Fed, that he doesn't buy the long and variable lags, that basically monetary policy is coming through as it is? If they hold rates higher, it'll simply be because things are responding in suit and the strength has continued? Or do you think that we might get a bigger whammy than we expect as companies and consumers have to refinance?
I'm with the former. I think we roughly know what the impact of monetary policy is so far, and if interest rates remain higher for longer, in the Bank of England they called it the table mountain, it's because the economy deserves higher interest rates. In short, if we don't have less supply in the world, if it's because demand is strong, then that's basically a good outcome, I think.
In many ways, the Federal Reserve was market to market. We already know the growth figures were better than expected since June, and they've extrapolated out current dynamics into next year and the year after. We can have a long debate about whether they should or not. I want to talk about the reality of UK growth right now. It was pointed out to me almost immediately to look at this line that they've seen the PMIs at the Bank of England ahead of the PMIs tomorrow. How bad are those PMIs going to be?
The PMIs could be quite bad heading through the second half of the year, although I would be wary placing too much weight on them, given the fact that they provided recession signals over recent years, ones which we haven't got. The key issue for the UK, no doubt, is monetary policy. There's a risk of a technical recession over winter, although I don't see the ingredients for a severe recession or anything like a significant crisis. Economic cycles end and turn bad because you build up excesses that central banks then pop simultaneously. And so in context of this whole argument, how long will monetary policy take before it has an effect? It's not as if central bank does something and 2 years later something happens. It's the accumulating effect. And we can see it across a spectrum of indicators that monetary policy is weighing on economic activity and that economic activity is resilient, which means if we do get this technical recession, well, we just cut interest rates.
Callum, just to jump in, we always hear that line, there are no excesses. There were excesses. Strong balance sheets for consumers and corporates, got all of that. But there was a big transfer, and you know where I'm going with this, and it came from the fiscal side. And we're really sitting here and saying there were no excesses on sovereign balance sheets in the last 3 years, because there certainly were.
So there are two excesses, and the major ones actually sit in the US. One is commercial real estate, and the other one is fiscal. Now, commercial real estate is a problem potentially for some of the banks, but I see no evidence from policymakers that they'll let any institution fail and therefore cause a systematic crisis. And so that's a concentrated problem we can discount. When it comes to fiscal, I think the only thing that the US needs to be concerned about is whether or not the bond market thinks that this is an inflationary policy at some point, in which case then the vigilantes say, you need to raise taxes, you need to cut spending. Short of that, the US can get away with a lot of borrowing. Deep, liquid markets, a robust economy, fiscal policy that's providing supply-side growth. Why, as an investor, would you not buy into this?
Can the UK?
No.
That's a problem, isn't it?
But the UK doesn't need it. The UK's got fading political uncertainty and significant pent-up demand. And so as long as the Bank of England doesn't cause a monetary policy accident, I think things look better into next year. I'm not a blue-eyed optimist for next year. I think it's going to be very difficult. I think 25 is when we see trend growth, but I think we get through winter and things should be okay.
TK's biting his tongue right now.
I'm not buying it. I just, you know what I'm thinking? OBE, overtaken, overcome by events every time. 10-year real yield just hit 2.10%. We're going to have a Mickey Levy world if we don't watch it.
Callum, good to see you.
Thank you.
Callum Pickering of Berenberg. If you are just tuning in, welcome to the program. Equities near session lows. We're down by about 0.9%. Some big moves in the bond market, up by 8 basis points on a 10-year. 448.20 on a 10-year this morning, Tom. Just amazing to see pushing 450 on a 2-year at the moment. The 2-year is just phenomenal, just to see this getting closer and closer to 520.
For the non-sophisticates, we are really seeing dynamics and changes. And the way you look at this is from the negative and low rates that we saw ages ago. We have migrated sharply up and breakthrough back to November, December of 2008 levels, John. When you begin to start to see us back to 05, 06 levels in some of these rates, that's a changed economy for everybody watching and listening.
Lisa, we've been having this conversation now for the best part of 18 months, and one of the #1 questions we asked was, can we live with it? We're living with it, aren't we?
Well, are we?
Doing that right now.
I mean, this is my question. We are, right? We're living with it, but are we? Because if you look at the rates that people are actually paying, who's paying these rates that people are quoting, right? This is, to me, the real existential question. If you've got to pay 7% on a house, you're going to buy it?
The great refinancing is still to come on the horizon out there. That maturity wall in high yield. I know all of Bramo's worries.
I know.
It's like market therapy
all
every
of them?
morning. You know, all of these worries. Not quite all of them, but you can have some of them back. Trey Trudeau on the UAW strike up next.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
It's what we do. I think, forecasts are useful, but only up to a point. There's a certain amount of ambient noise in the economy. You can't get away from that. You can't live with them and you can't live without them, I guess is the way you would say that.
The brilliant Jim Bullard, the former St. Louis Fed president, speaking with Mike McKee. Fantastic conversation exchange a little bit earlier on this hour. Sometimes Twitter gets it done, now known as X. There's some really bright people out there, particularly for the finance Twitter community. This line from Stu Hampton on Twitter this morning, I think this is really thoughtful stuff. Could these hawkish pauses be interpreted as tacit admission that stagflation is a very real possibility? I'll share that again, Lisa. Could these hawkish pauses be interpreted as tacit admission that stagflation is a very real possibility?
The idea that if they're not raising rates further, they're going to tolerate higher inflation and slowing growth, and that is the preferable recipe for them, which is otherwise known as stagflation. Maybe we kind of heard that a little bit in the UK in particular, and that's kind of why you're seeing bond yields in the long end in the UK creep higher.
Can you really get inflation back to 2% with 4% unemployment in the United States? Maybe you can. It's not for me to say that you can't, but we're asking that question today, aren't we?
If you believe that long and variable lags is an outdated theory and that what you see is what you get, then what they're basically doing is they're allowing things to be where they are as things work into the system, and that they basically are talking about stagflation.
It was interesting seeing the gilt market sell off the back of that Bank of England decision to pause, with the yield high now on the 10-year, Tom, by almost 13 basis points in the UK, on the 30-year up by about 11 basis points. And just to give you the update on the Treasury market at the moment, 10-year just short of 450, 2-year at the moment is just short of 520.
We're supposed to be measured, we're supposed to not go OMG and all that, but the answer is this is an OMG day. You see it down in the equity markets, 0.9% move SPX. Dow really hasn't moved like maybe it should, but the answer is, John, bonds are speaking with a vengeance, and they're really buttressed up against breakouts and, whichever way you're looking in the series.
Lisa, not to lose sight of the equity market, of course, we are softer here. The S&P 500 negative by about 0.9% on the session.
And there's some really interesting stories under the hood. FedEx in particular reported earnings. Remember, we were saying that they were going to report earnings. They did. And you could see those shares popping up to this morning after in pre-market trading after those earnings came out. Why? Cuts to costs. And because they were getting business and able to raise prices because people were switching away from UPS because of the strikes, and they were getting some of that business back. So I thought that was kind of interesting, up about 5%. Again, what are the ripple effects of some of the strikes? We're going to be talking about that a little bit later. I want to whip through Cisco as well as Broadcom, some interesting information with Cisco buying Splunk. It's basically artificial intelligence, cybersecurity. It's their biggest acquisition to date. So this is something.
Stock doesn't like it.
No, the stock doesn't like it because it's their biggest, acquisition to date. They're using their cash. Chuck Robbins does. He's like, this is so good. We're going to do great.
Catch up with Chuck soon. It's been a long time.
It's been a long time. Broadcom is interesting. Alphabet is thinking about dropping Broadcom as their chip supplier for AI. So the chip wars continue, and you can see that ripple effect with Broadcom shares down 1.6%. Amazon, to me, is really interesting. Those shares lower by 2.7%. And right now, in general, NASDAQ shares in general are lower just because they were the most inflated by rates where they were. but they're scrapping a planned fee on merchants that don't use its shipping services. They were under so much scrutiny for antitrust. They're not going to charge their merchants 2%, which stock investors don't like because you're not getting the revenues. But, you know, at the same time, how much is this going to be a steady push toward Amazon to stop monetizing some of their dominance?
To the strike in America, and I must tell you, it is sobering here in London to see a true strike of doctors really click in today at the NHS. It is different in America. It's about automobiles. And what I find is there's a lot of mythology involved. We're going to now throw the mythology out the window with Craig Trudell, who lived the mythology. He knows what a 1948 Fleetwood 60 is. It's what you bought when you'd made it after World War II. And that's just complete. What I've learned in the last 48 hours is this has nothing to do with my grandfather's UAW. What UAW are we observing into the weekend?
We're observing a UAW that is really trying to get its mojo back, right? This is a union that has given up a lot of concessions over the last couple of decades to try and get these companies at first back on their feet and then thriving. That is what we've seen. We were talking during the break about the sort of carpocalypse days of 2008 and 2009. The union gave up an awful lot to help these companies to have a future out of that crisis. Putting their retirement benefits and healthcare benefits, either doing away with them or putting them on the unions, making them union liabilities. We now have a union that is trying to claw some of that back, and companies kind of using this massive transformational change coming to this industry as a sort of wedge to resist that after 4 years of very strong profits from them.
What is the singular power in negotiations that the UAW has right now?
I think they have. We were talking just a few minutes ago about how tight the labor market is in the U.S. I do think the fact that we are regularly still hearing about challenges on the part of these companies with finding skilled workforce. I think it's going to be something that we'll hear more and more about as we're hearing about thousands of workers being hired at battery plants across the country to meet the Biden administration's objectives to go electric, to make this transition from combustion engines to batteries. You're going to need a lot of people for that, and you're going to need people who know how to make stuff. And that is what the union has in its favor is a lack of many people left anymore who have that experience.
There are hundreds of cars that are not being produced right now, cars and trucks, because of the strikes. How much is this going to jack up car prices?
I think actually it will depend, of course, on what we hear even just tomorrow from the union in terms of what their next move is. At this point, we're hearing about 3 plants that have gone down about a week now. That isn't really going to be enough to meaningfully change things. You have also working in the company's favor the fact that over the last 6 to 8 months or so, with the chip crisis easing to a significant degree, they had a lot of inventory going into this strike versus what they would have had just a year ago.
A lot of factories outside of the U.S., in particular in Asia, have a significant proportion of robots doing a lot of the work. Is the U.S. moving in that direction? And is this basically accelerating those discussions behind closed doors among certain executives? Is the U.S. moving in that direction? And is this basically accelerating those discussions behind closed doors among certain executives?
I think you do still see a trend toward automation, but I do think that, it's also the case that you're going to need a lot of labor even to do manufacturing of batteries and electric vehicles that, have fewer moving parts. Even Tesla, has an awful lot of people at their plants in California and Texas and in Shanghai. You do still need a lot of labor to put these vehicles together. So is there a sort of ever moving change toward more automation? Absolutely. Are these companies still going to need a lot of people? That's still the case as well.
Craig, let's finish on the UK. Prime Minister Sunak is pushing back the date for that full transition to EVs from 2030 to 2035. From your perspective and the reporting you're doing, is that electoral strategy or is that a reality check?
Very much the former. I think actually, if you look into the sort of fine print of what Boris Johnson announced just under 3 years ago, this was the plan all along. It was always going to be the case that petrol and diesel cars were going to be allowed. They just needed to have, some electrification to them from 2030 to 2035. So this is a doing away of a half-baked announcement that was sort of misinterpreted and misunderstood for the last 3 years. It's all a lot of theater. We'll see in the next, day or so whether, as the FT reported today, we'll get a zero-emission vehicle mandate particulars. I mean, we're almost into October, and we still don't know, as an industry, how many EVs we have to sell to comply with rules here in the UK.
Amazing.
It's a mess.
I'm asking for a friend. Can I take a London taxi and bring it to America, the great electric taxi?
Tom likes the quiet.
Can you bring it over?
I learned that the reason that for the design of them, the top hat, you used to the reason was for gentlemen to be able to keep their top hat.
That's why it's like tall at the back.
I do that,
Very cool. You can wear
The maker of the London taxi is now Chinese owned. So.
I do that.
Craig, thank you, sir. Craig Trudell of Bloomberg. We've still got a lot to talk about today. In about an hour from now, we'll be sitting down for the Bloomberg Global Credit Forum here in the city of London. We'll be catching up with Jim Zelter of Apollo Asset Management, the co-president over there. He's joining us here in the city. And what a time to have a conversation about fixed income.
The timing of this?
Just amazing, with a 10-year pushing 450 TK and a 2-year getting closer to 520.
Let's plan the conference out 4 months, and can we be sure we've got a moonshot and a 10-year real yield? We can do that. Julie was amazing at that.
Yeah,
she nailed it.
Not just that, but does this change anything for them that people aren't expecting them to go down anytime soon?
Amazing. A Bloomberg surveillance special live from the Global Credit Forum here at Bloomberg, coming up in about an hour from now, from the City of London. Good morning.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
This is Bloomberg.
Good morning from New York City. For our viewers worldwide, I'm Matt Miller in for Jonathan Farrow, looking at futures that are substantially down and rates that are off to the races. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, futures fall as jobless claims hit the lowest level since January. Investors on edge as policymakers ramp up the hawkish rhetoric, and time running out in Washington, D.C., with strikes and shutdowns looming over markets. Let's kick it off with the big issue, higher for longer.
We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. A soft landing is a primary objective, and I did not say otherwise. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%. The savings rate for consumers has come down a lot. The question is whether that's sustainable. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
Joining us now to discuss is Zach Griffiths of Credit Sites and Samir Samana of Wells Fargo. So a lot to talk about, but I've got to draw attention first to the 10-year. What we're seeing right now is the highest level since 2007. Does it make sense that we get this big pop in rates? Zach, I'll start with you after the jobless claims numbers came in lower than expected.
That's certainly supportive of the idea that the Fed is going to have to remain higher for longer. And I'd say yesterday's hawkish pause was even more hawkish than we had expected, with the 50 basis point increase in the policy rate indicated by the 2024 dot. And so I think if you're seeing the labor market starting to show signs of tightening again, and I think overall we've seen better balance in the labor market recently outside of this jobless claims print, that would be more supportive of a balanced approach. But I think the pop today is really the 1-2 punch of the Fed yesterday, jobless claims this morning. And the Bank of England, even though they kept the policy rate on hold, they did up their pace of quantitative tightening. So a lot of hawkish developments to consider, and I think that's definitely a big driver of what we're seeing in yields this morning.
Right. If you look around other central banks, we see a little bit less or fewer hawkish moves with, the central bank in Switzerland holding. We were looking for a hike there. We're just getting headlines out of the ECB right now saying that they think, at least according to Stornaris, that the ECB has reached peak rates. The next move is likely a cut. Nonetheless, here it looks like we're taking out, certainly from the dot plot, planned cuts from next year. We were looking for 4, now we only see 2. Samir, what do you make of the Fed's moves yesterday and the data that we got this morning?
Yeah, I mean, look, none of it's terribly surprising, right? I mean, the economy's been surprisingly resilient. You've seen commodity prices start to move back up to recent highs, which will also feed into, broader inflation, right? When you think about, gasoline prices and diesel prices with, kind of the Russian ban this morning, those should get an additional, kind of bump this morning. And so that's going to flow into all those, packages that we're all about to order for the holidays. And the Fed is very much on guard with respect to the longer those prices stay high, the more likely that they are to start flowing into other parts of the economy and consumers' inflation expectations.
In terms of, what we're looking for, it does seem like the Fed, is still expecting to raise rates, or certainly 12 out of the 19 dots were for one more increase by the end of the year. Do they really go through with that, Zach, or are they just leaving their options open?
Man, I think they're kind of taking a risk management approach with the dot plot, almost the same way that they did when rates were at 0, signaling that rates would remain at 0 for a while. They're kind of signaling they have the option to hike again, and they plan to leave rates very elevated for a long time. But when we think about what's realistic with a policy rate at 5.1% at the end of 2024 and all of these tailwinds we've seen for the U.S. economy starting to come off, whether you think about excess savings evaporating, the restart of student loan payments, we find it hard to believe they're actually going to be able to maintain the policy rate there unless inflation surprises considerably to the upside versus what we're expecting. Chairman Powell yesterday alluded to the real policy rate, and that has risen substantially. It's higher than what the New York Fed estimates neutral is. And so we are questioning whether or not they can get even more restrictive in 2024 if inflation does come down the way we're anticipating. And so I think it's a risk management or almost an insurance approach, but we're skeptical they can actually keep rates that high for that long.
All right, we just heard from former St. Louis Fed President Jim Bullard. He says the central bank, in his view, may need to raise rates further. Listen in.
The committee left the additional rate hike this year in the dot plot. I think that may be a good thing to do as insurance to make sure that core inflation especially continues to come down at an appropriate pace so that the committee can get back to 2% inflation in a reasonable time frame.
Let's get over to Bloomberg economics and politics editor Mike McKee. He just did that interview. And, you know, at the same time, essentially, as you were doing that, we got these new jobless claims numbers out, much lower than expected. Does it look like, you know, the labor market is still strong enough to withstand further increases?
Well, you know, the Fed did price a stronger labor market into its forecast yesterday. So I'm not sure how much of a surprise this is to them, except that the numbers are pretty dramatic. Just 201,000 jobless claims filed last week, a drop of 20,000 from the prior week. So it is an amazing number, the lowest since last January. Does it keep going? Well, we don't know because we don't know the impact of the auto workers' strikes. Just started last Friday, so that was too soon for people to start filing. The other side of that is that this was the week for the jobs survey for the month of September. And if that's the kind of strength we're going to see, it will raise questions for the Fed down the road. Now, the Philadelphia Fed index comes in much, much lower than anticipated, and their prices paid number went up, which is going to be interesting, get some attention down at the Fed. But at the Fed, as Jim Bullard and I were talking about, they have now moved to a more compressed view of what's going to happen. But you can see the green line over the red line. Those are the different paths that we see now because the Fed has decided higher for longer. Doesn't mean they're going to raise again, although they could, but it does mean that they're going to bring down rates much more slowly. Jim Bullard said they could go 18 months at these levels. So we'll have to see on that. Here's the forecast that got everybody's attention. The GDP number more than doubled for this year to 2.1% for the Fed, and then 1.5% up significantly for next year. Unemployment not going to fall as far as they had previously forecast, and inflation's going to come down. Those sort of things don't go together. If we're going to have a really strong economy, is it not going to produce inflation? We shall see, and we shall see what the calendar is going to give us going forward. They have a next meeting on November 1st, and between then we have jobs, 2 inflation reports, and the employment cost index, which will tell us something about where we are with wages. The big question is the government shutdown, Matt, on October 1st. If that happens and the data providers don't provide the data, it's going to be interesting for the Fed to see what they do and how they measure how the economy is doing to decide whether they want that extra move or not.
Yeah, absolutely. A couple of really fascinating headwinds to throw into this, a wrench really to throw into this economic machinery that looks to be firing on all cylinders. I want to quickly get away from the Fed discussion and go to some breaking news that we have on Fox and News Corp. Rupert Murdoch stepping down as chairman of Fox and News Corp. I don't even need to say what an important person this is in terms of not only those stocks and those businesses, but really the global media and really global culture that he has affected. Let's get over to Abigail Doolittle right now, who has more on this breaking story.
Yeah, absolutely, Matt. We do have these headlines that Rupert Murdoch is stepping down as chairman of Fox and of News Corp after a 7-decade career with these two companies. Stepping in as the sole chairman of Fox and News Corp is his son, Lachlan Murdoch. And we will have Rupert Murdoch becoming the new role, taking on the new role of chairman emeritus of Fox Corp and News Corp. The stock is not really reacting at all, Matt, but this is very, very big news, and I'm sure that we'll be exploring as the day goes on. But Rupert Murdoch, who really built a true media empire over 7 decades that revolutionized news and entertainment and made him one of the world's most influential and perhaps controversial tycoons. He is, of course, 92 years old, but he is stepping down, and his son Lachlan Murdoch is taking over as sole chairman of both Fox and News Corp.
Yeah, we're watching succession happen in real time right now. Rupert Murdoch, of course, born in Melbourne in 1931. He's 92 years old, and it looks like at this point he's continuing a passing of the torch that started with Lachlan and James years ago. We'll continue to cover this story because it's absolutely fascinating. Rupert Murdoch, again, stepping down as chairman of Fox and News Corp. Let's get back, though, to the rate story. I mean, looking at the effect in markets of the Fed's more hawkish than expected pause yesterday and the economic data that we've got out this morning, it's not just showing in rates, right? We see, obviously, a big move in King Dollar as well. Samir, what do you think about right now the Bloomberg Dollar Index at 1258? I saw it earlier closer to 1260. So the highest level that we've seen in a year, and we're seeing drops in other currencies versus the dollar because other central banks aren't nearly as hawkish.
Yeah, I mean, look, we are still the relative bright spot around the world, and I think the dollar probably has more upside, especially into the recession that we anticipate, kind of unfolding later this year and into the early part of next year. With respect to broader markets, I mean, I think risk is going to struggle here. So, equities are probably, capped in somewhat of a soft way by rates. And the higher they go, probably the lower the multiples, in order to adjust for that. And so we think, probably the next move for the S&P is probably down to our year-end target range of around 4,000 to 4,200, and investors should position accordingly.
Zach, is this, I was asking yesterday and probably last week, are rates at these levels a screaming buy because they can't go any higher? And yet I continue to see them march higher and higher. What do you think about owning treasuries right now for some risk-free return and possible capital appreciation?
Well, I'm not going to say they're not going any higher, but we do think this is an attractive time to get long duration. We have been advocating to clients now that we've moved above 4%. It's a good time to start legging in and maybe extending duration relative to your benchmark. But we've also advocated a barbell approach as the curve is still very inverted. You can pick up a lot of yield at the very front end, but we like balancing the reinvestment risk of hiding out in the front end with adding duration at these levels. We do think as you look forward, if the Fed is in fact done, which is certainly up for debate, yields tend to fall pretty substantially in the 3-month and 6-month period following the last rate hike in a tightening cycle. Now, again, I'd say the message yesterday is the Fed may not be done and yield higher for longer than we had anticipated, but we still think when you look at real yields, 2% on the 10-year, that's very attractive, especially for some of these liability-driven investors that have a structural demand for duration, and you have better funding metrics, especially for some of these pension funds. We think that that's going to cause continued de-risking of the portfolio, and yields at these levels look good to us.
Samir, what do you think about, buying rates right now, even corporates and selling stocks?
Yeah, no, we would agree. Well, that's exactly where I was going to go with it is, on a relative value basis, you've got an equity risk premium of pretty close to zero, right? You're within a kind of a rounding error. And so, for equity investors, I mean, they should be thinking about whether they should be taking as much risk as they have in the past. There's been plenty of surveys about, older investors maybe kind of having been, kind of on kind of cruise control and maybe having a little bit too much equity in their portfolio because rates were so low. Now with cash yielding, upwards of 5% and the long end, yielding upwards of 4%, they should really rethink that, some of those allocations and there might be more, attractiveness for them on the fixed income side. One other point I'll make is on the muni side, especially for taxable, high income, tax bracket, folks, the taxable equivalent yields are pretty attractive there. So we would also throw that out there as a pretty good place to find some income.
Joe Mysak and Paul Sweeney will be happy to hear that. Samir Samana from Wells Fargo, Zach Griffiths from CreditSight sticking with us. Right now, I want to get a look at what's going on in stocks, down, obviously, in terms of futures ahead of the opening bell. Let's bring in Abigail Doolittle. Abby?
Well, Matt, we are, in fact, seeing some pretty harsh downside action for stocks. In terms of some of the individual movers, let's start out with the shares of Broadcom because they are dropping precipitously, down about 6%. And this after a report from the information that Google executives have extensively discussed dropping the semi-chip conductor maker as an AI chip supplier as early as 2027. Investors clearly not liking that news. Cisco down 4% on the news that they are paying $28 billion to buy Splunk in a software push. They, of course, are getting away from their more traditional networking. And then to the upside, FedEx up almost 5% after the delivery company raised the lower end of their fiscal 2024 adjusted earnings forecast. Investors liking that. And apparently, ground delivery, it's doing really pretty well. We'll have more on that after the bell, Matt.
All right, Abigail Doolittle looking at stock market for us. Coming up, markets facing mounting headwinds from Capitol Hill.
If the union gets anywhere near the wage increases they're asking for, it just makes the Fed's job even tougher to constrain inflation. In terms of the government shutdown, clearly that's a net negative for risk assets and growth in the short term.
A lot going on today. The open in 14 minutes. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
If you look at the UAW in particular, it's part of a broader trend, right? Where labor has far more power than at any time. On the one hand, obviously the strike puts a little bit of downward pressure on GDP growth. But on the other hand, if the union gets anywhere near the wage increases they're asking for, it just makes the Fed's job even tougher to constrain inflation. In terms of the government shutdown, clearly that's a net negative for risk assets and growth in the short term.
Time is running out on Capitol Hill. An auto strike and a looming government shutdown threatening the Fed's dream of a soft landing. with key deadlines drawing near. The UAW, for example, unimpressed by the latest offer from Stellantis, signaling workers will reject it with just 1 day left before the deadline to expand their strike. A negotiator saying, quote, "It didn't look good for us. The holdup is product. They didn't want to line up products for our plants for the future." This as the risk of a U.S. government shutdown remains high just 10 days before a funding lapse. Speaker McCarthy revising his plan and winning the support of some GOP holdouts, telling reporters, quote, "We're very close there. I feel like it's just got a little more movement to go." Let's get to our team coverage. Bloomberg's Anne-Marie Hordern here in New York for UNGA, and David Welch, our bureau chief out in Detroit. Anne-Marie, let's kick it off with you. How likely is it that we have a government shutdown?
Well, we're heading towards that at the moment, although Speaker McCarthy did have a meeting last night. It lasted about 2 hours with the entire conference. And I think there's a few things you need to watch out for. This morning, we're going to see a vote on the rule of the defense budget. Remember, they voted it down whether or not to even debate it. Now we're going to see whether or not the conference is united and if they will even debate the defense bill. If that goes to the floor, that does show a little bit of movement within the Republican caucus of the House. What McCarthy is trying to do, though, with this continuing resolution that has a lot of provisions that the hard right flank of his party wants to see, is he really wants to make sure he's exploring all these options to keep his conference together, to have some leverage in the Senate. We saw this same strategy with the debt ceiling negotiation. Of course, the issue is that is likely going to be dead on the arrival in the Senate. So if it does come back to the House for a vote, it's going to be more of a moderate, toned down, continuing resolution to keep the government open. They have 9 days to do this. And then the issue, of course, that McCarthy personally faces is the hard right flank may say, we want a motion to vacate, and we don't want you to be our leader because you are not delivering on your promises.
All right, Anne-Marie covering the shutdown for us, David Welch on the strike. And I think this took a fascinating turn because we're all used to talking about, wages, possibly a pension, maybe a 4-day work week. But the union is saying to Stellantis, you need to line up some more products. What are you going to make after the Challenger and Charger in Brampton?
Yeah, look, they want job security guarantees at this point, and we really, they've always wanted that, but we haven't heard that quite as much as we've been talking about pay and talking about pensions and economic, let's say broader economic issues. So I thought that was interesting as well. And this is just reading tea leaves here. Maybe they are getting to a point where the union realizes that, hey, this is a pretty good pay raise that they're getting. And when I asked negotiators who were on the picket line outside of Stellantis North American headquarters in Auburn Hills, suburb of Detroit, I said, what's the holdup here? And that's what they talked about most. That doesn't mean that they have totally agreed on pay or some of these other economic issues, but that was the big thing they said was the sticking point, is guaranteeing new vehicles in certain plants. I think Belvidere, Illinois is a very big one, but I think they want to see some product guaranteed throughout the life of the agreement and if they could, beyond. That tells you that maybe some of the pay stuff we've been talking about for the past few weeks could be getting pretty close.
Maybe they can get guarantees for Dodge and Chrysler because those brands look doomed. David, thanks very much for that. David Welch out of Detroit, Anne-Marie Hordern here in New York. Let's get back to Zach Griffiths and Samir Samana. Samir, what do you think about these, twin threats to a soft landing? How important are they?
I mean, it's going to make the Fed's job a lot harder, right? I mean, whether it's oil prices, whether it's the strike, whether it's the shutdown, which could actually cause data to go dark, right? I mean, how do you have a data-dependent Fed without data? So for all these different reasons, again, we think they probably raise in November. Now, if there's not enough data, it's possible they skip it, but we do think they probably raise in November. We do think there's a little bit of a downward bias in risk markets. Maybe that takes some of the pressure out of the system with respect to, consumers maybe not feeling as good, maybe, pulling back a little bit on their consumption. But to the extent that you passed all these, kind of wage hikes, whether it's pilots, whether it's, auto workers, the tricky part's going to be, it's going to be a while before those start to kind of roll off and become more, I guess, less, attributable to inflation increases. And that's why we think for the most part, a lot of this caution may carry into the next, first part of next year.
Zach, in terms of the UAW strike, if it goes on, in terms of the government shutdown, if it's prolonged, I mean, isn't that inflationary and problematic for the soft landing?
I think it's definitely problematic for the soft landing, Matt. And when you think about what the UAW is looking for, I think some of the demands are kind of a right sizing in terms of wages relative to what we've seen since their last deal. I think some of the progressive increases in wages that they're asking for are a little bit ambitious, let's say. And so that certainly could be inflationary depending on what gets passed. I think when you throw in the government shutdown, the potential for the strike going on longer, that's going to be more volatility in markets. And we've really seen volatility come down quite a bit. And I think that complacency is what's going to get called into question over the next couple of weeks.
Zach Griffiths and Samir Samana, thanks very much. Coming up, the morning calls. Then later, RBC's Lori Calvasina joins us after the opening bell on whether big tech can survive a big jump in rates. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you would be.
breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority. Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg.
This is the countdown to the open. I'm Matt Miller, in for my good friend Jonathan Farrow. Moments away from the start of trading, we're looking at big drops on S&P, NASDAQ, and Russell 2000 futures after the Fed gave us a slightly more hawkish hawkish pause, I should say, than we anticipated. There you hear the opening bell. Trading starts right now. Let's take a look at some of the other asset classes here. Switch up the boards for me, if you would. The euro dollar right now at 106.54, and a lot of currencies falling against King dollar this morning after that Fed hawkish pause. The 10-year yield kind of off to the races, off of its highs for the session, but still at the highest level that we've seen since 2007 at 447.18. And NYMEX crude, which shot up at the end of last week, the beginning of this week, hasn't been doing a whole bunch since then, still hanging around $90 a barrel for West Texas Intermediate and under 95 for Brent. We do have one stock that we want to watch closely at the open. That is FedEx. Those shares rising after the Courier boosted its earnings forecast. Citi saying the company's performance is, quote, quite encouraging, and guidance is reasonably conservative. Abigail Doolittle joins us now with more. Abby?
Well, Matt, yes, a very solid quarter here from FedEx, and right now the shares are on pace in this difficult tape for the best day since June of 27th, up for a third day in a row, the best day since the middle of July. So we have some strength here for FedEx. The fact that it was trading higher into the report suggests that some investors are not entirely surprised by the fact that they beat, and they also raised the lower end of their guidance. It's interesting because UPS on the year down more than 10% or thereabouts. FedEx up more than 45%. So they're continuing to take ground from UPS, suggesting that UPS's weakness and issues is more UPS specific. What investors are also really pleased about here with FedEx is the fact that they, are really the $6 billion worth of cost cuts that's really dropping to the bottom line, or it will in the future. Again, they raised the low end of the guide. Lots of price targets raised on the street, and overall, Matt, this is just again a really solid beat and raised quarter. Investors rewarding the stock, the company, despite these difficult trading conditions.
Yeah, and also, I mean, a huge barometer for the economy as well. So always fascinating to look at FedEx and UPS earnings as well. Let's get to that breaking news that Abigail was talking about a little bit earlier in the program. Fox and News Corp stocks fluctuating after news that Rupert Murdoch, their 92-year-old chairman, will step down and pass the baton to his son, Lachlan. Katie Greifeld joins us with more on this developing story. Katie?
Well, Matt, yeah, like you said, this is breaking huge news in the media space. Rupert Murdoch stepping down as chairman from both the Fox and the News Corp boards, moving into the chairman emeritus position and making way for his son, Lachlan Murdoch, to become the sole chairman of News Corp, in addition to his roles as executive chair and chief executive officer of Fox. Now, in a statement Thursday morning, Lachlan Murdoch congratulated his father on, quote, a remarkable 70-year career. Of course, Rupert Murdoch, aged 92, he built what is now a global media empire over the course of those second decades. You take a look at the shares right now fluctuating. We can go ahead and call that unchanged. And let's check in on some other media movers this morning, Matt, since this news lands as the writer and actor strikes grind on over in Hollywood. Warner Brothers Discovery and Paramount shares, though, slightly higher this morning. The Writers Guild and the Hollywood studios said that they would meet for a second day, maybe a sign that these two sides are inching closer to a deal.
All right, interesting stuff on Rupert Murdoch. We're going to continue to cover that story. Still, he is younger than the chairman and CEO of Berkshire Hathaway. Let's talk about IPOs starting to lose some of their luster. ARM falling below its IPO price of $51 a share. Its fifth consecutive day of decline. Simone Foxman joins us now for more. So we're seeing, Simone, pops that essentially dissipate rather quickly.
Yeah, I mean, we have to wonder at this moment if some of the sheen has come out of this IPO market, because all of these IPOs, ARM, Instacart / Maple Bear, Klaviyo, were oversubscribed to begin with and closed substantially higher than their IPO price. But we're looking at ARM, again, priced at $51 a share, now $52.30-ish. Instacart, priced $30 a share, now about $31, and Klaviyo close to $32 a share after pricing at $30 a share. So we're a little still above those initial IPO prices, but we definitely saw some weakness in yesterday's trading, especially as we got that news from the Fed, that Fed decision suggesting higher for longer, when the juice really came out of the S&P 500. Now, part of this could be analyst-driven as well. The banks that were involved in this IPO still in quiet periods, and Instacart, the initial analysts coming out with some very lukewarm takes on how that company will do amid competition. Only one buy rating at the moment, even for ARM. It has 2 holds and 1 sell rating. But certainly there are lots of companies who have been maybe thinking about staging their initial public offerings soon, that are watching how these companies are performing over, not just today, but over the next couple of weeks, looking for some indication of whether it's a good time or not to get into the market, Matt.
I believe, by the way, it's pronounced Klaviyo.
Klaviyo.
They do software as a service for back-end application programming interfaces. Simone, thank you very much for that. Now, some big news in the networking space and software space this morning. Cisco agreed to buy cybersecurity company Splunk in a $28 billion deal. Meanwhile, Broadcom shares under pressure after a report that Google is considering dropping the chip supplier. It's going to design its own chips in-house. Ed Ludlow joins us here from the West Coast for the week. More on the tech sector. Ed?
Yeah, $157 per share in cash, a $28 billion deal. This is so in line with Chuck Robbins, right? A networking gear seller like Cisco adding the software services. In complement to that, Splunk is a data indexing business. Basically, you can monitor network users in real time. It has a cyber security element. For those investors or Cisco and Splunk investors out there, this deal will not impact Cisco's previously announced share buyback program. Splunk CEO Gary Steele is actually going to join Cisco's executive team and report into Chuck Robbins. That's a big piece of M&A. Shares reacting negatively, but I would say most sell-side notes that I've seen are pretty positive on this deal. The information is reporting that Google will drop Broadcom as soon as 2027 for its proprietary silicon AI chips that go into data centers. Broadcom is an AI play in the sense that it offers what we call ASICs, application-specific integrated circuits. So if you think about an NVIDIA H100, that is a GPU that it has multiple use cases but can handle lots of data in parallel. The TPU that Google wants to use in its data centers is for a very specific AI workload. And what the information is reporting is that, according to a person familiar with the matter that they did not name, is that Google thinks it can save money and just design the chip itself in-house and then go away and have it contract manufactured. So this is an interesting deal. Google's been working on this TPU since 2016 with Broadcom. Now, according to this report, it seems like they want to go it alone, and the shares are reacting as such.
By the way, is this a trend? I mean, Google thinks it can save not just money, but billions of dollars, right? On the other hand, they don't have the experience and the years behind them that Broadcom has doing this. We've seen Apple pull back a little bit on its plans to do stuff like that in-house. Is this a trend that these tech companies are realizing they can't do exactly what the chip makers do, at least not at that pace?
In very specific cases. So what Apple pulled back from was the modem that Qualcomm does, the specific short distance connection. On the processor side, Apple is fully pushing ahead with its in-house silicon. It has the cutting edge of 3-nanometer smartphone processor, designs it itself in TSMC, contract manufactures it. It's a similar story with the Google TPU. There are many AI-related chips on the market, and we've talked about NVIDIA H100 being the best. But if you can control the design, find the contract manufacturing partner, then you can get yourself a higher margin processing for your data center. You can control the compute and energy efficiency, and that seems to be their direction. Not just Google, Amazon is doing it as well, right, with AWS. They have 2 generations of proprietary chip.
Ed Ludlow sorting us out there, and you can catch his program every day at noon, Bloomberg Technology with Caroline Hyde. Now, Wedbush posing the question, can tech stocks rise in a higher for longer landscape? Analyst Dan Ives, a noted bull, writes, now is not the time to become scared by the Fed. Stronger fundamentals and rate cuts on the horizon will create the start of a risk-on environment with the new tech bull market kicking off. Now, he's a bit of a cheerleader there, but one that we respect and love. But let's continue the conversation with Lori Calvasina of RBC Capital Markets. Lori, obviously Dan is very bullish, but higher rates, historically not great for growth in tech companies. Is it a problem this time?
Well, thanks for having me on as always. And look, I think the question of whether or not it's a problem is a question of your time horizon and also a question of what else is going on for tech stocks at the moment. One of the things that we see when we look at the growth trade broadly right now within the big cap landscape is that growth has been extremely crowded. If you look at CFTC data on NASDAQ futures positioning, and if you look at growth relative to valuations on a weighted multiple, so taking into account, kind of giving extra heft to those bigger mega caps, we've basically been around recent peaks in terms of that relative valuation, and it's starting to come down. We're also starting to see the positioning correct, but we've still got a long way to go. I actually like tech longer term. I'm keeping my overweight on. We do those calls on a long-term kind of 12-month view, but we're acknowledging that there are some tactical problems here. And so you take that crowded overvaluation situation with the growth trade and you slap on all this talk of higher for longer, it gives you a catalyst to rotate out of something that probably needed to take a breather anyway.
So, but you think longer term tech can survive higher for longer. What if we don't get the soft landing? What if we get a recession that results in deep cuts? Is that bad for tech because the economy slows down, or is that good because rates come back down?
I think it's actually more good than bad longer term. Again, you have to get through this initial problem with the tactical concerns. But what we've typically seen is that when GDP is running in real terms below 2%, that is typically when the growth trade is outperforming the value trade. Stocks have essentially taken on a quasi-defensive role in portfolios these days. And if you think about sort of the market cap of the traditional defensives, they're just not as dominant as they've been in the past. And so what we do see is that when you're in these subpar economic growth periods, that people rotate out of the more value cyclical oriented parts of the market and into not just the defensives, but the growth areas as well. So if you think about, sort of the Fed commentary we got yesterday, they're still anticipating, they're baking in the soft landing, right? But they're saying GDP is still going to be sluggish and below that 2% mark for quite some time. Longer term, that is still a good setup for growth. So, and tech stocks are a big component of that growth trade.
What are the tech stocks, what are the tech sectors specifically that you like the best right now, Lori?
So I'm still intrigued by semiconductors. If you look at earnings revision trends, it's a very good for broader for when you want to get in or out of that space. And we basically had trough-like earnings revisions within semis last year, and they've started to run. We're about kind of halfway through an upward revision cycle. We're not back to peak-like upward earnings revision trends, which is typically a sell signal to get you out of that space. If I look at software, by contrast, you've had earnings revisions that have been quite strong for quite some time. So we're not really seeing, kind of that mid-rebound. I think the fundamentals on the software stocks are very intriguing longer term, but you don't have that sort of short-term earnings revision recovery dynamic, that makes the semis look pretty interesting.
I was just talking to Ed Ludlow about this, Lori, and it seems like, at least in pockets, we see, Apple kind of admitting we can't do everything that the chip makers can do in-house, at least not as quickly. We saw that today in a sense from Google, or actually we saw Google say they're going to do that and maybe back down on it later. Do you think that's the case?
I don't know if I can get that granular into that particular debate, but I do think semis are essentially the backbone of the new age economy. And, and to a certain extent, they are commoditized, but in a certain sense, you do need a real specialization. So, I would still look at the semis themselves, to be honest.
In terms of M&A, we had a big deal this morning that Ed was talking to us about. M&A, though, has been slow. IPOs had been slow. Is that turning around now that we see more people coming to market and some deals getting done?
You know, it's interesting. I used to cover the small cap space, and you kind of think about IPO markets and small cap performance going hand in hand. And I was listening to sort of your show earlier today, where you're talking about sort of these pops in the IPO market not really sticking. I could have very easily written that about the small cap space and the attempts to sort of bottom and start to outperform large caps over the last few months. I mean, the small caps are just sort of a good gauge, for kind of risk-on behavior, I think, similar to the IPO market. And we've seen just a series of failed attempts in the small cap space to really just kind of break out and rally. And longer term economic concerns, the idea that the market is not quite done with this, maybe we're just delaying the recession instead of avoiding it, has really, cast some doubt on the small cap space. I think the other thing, for sort of the riskier parts of the market is pushing out some of the Fed cuts, reducing some of the Fed cuts for next year. I've always been telling people small caps are really dependent on getting rate cuts as a potential catalyst coming in here. So I think, that was not such good news yesterday necessarily from sort of a risk perspective.
And as a result, we see the Russell 2000 underperforming the other indexes. Lori Calvasina, always great to get time with you. Thank you so much for stopping by. Lori Calvasina there of RBC. Coming up, Q3 earnings cycle starting to ramp up already.
The earnings cycle is now turning up. Inflation is now falling enough to take the pressure off profit margins. Looking forward to next year, which I think is going to drive this sort of fourth quarter rally, is return to double-digit earnings growth.
KB Home reporting soft gross margins. That conversation up next. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Do you see a future for Monumental as a public company?
Yeah, I think so. I think what we found is the leagues have opened up to new pools of capital. Over the last year or two, both the NBA and NHL have allowed professional investors to come in, not as individual owners, but as funds. So that's a whole new pool of capital that didn't exist before. Sort of shows a whole new asset class opening up for professional sports, not just teams, but professional sports enterprises.
I think the sophisticated analysts will be looking at this industry, and as our revenues start to get in the billions of dollars, yeah, I think that you'll see a wave of companies go public. Whether we will or not, there's a big responsibility when you're a public company. And I tell people, we're a public company already. The scrutiny that you're under in running a sports team is, I think, much higher than a public company CEO has to live with. We'd be prepared to do it. Just the market would have to be right. We'd have to emotionally be ready to do something like that. But I think Monumental will be one of the 3, 4, 5 best-in-class organizations that, if that time was there, sure, we could go public.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
The earnings cycle's now turning up. And it doesn't have really very much to do with the real economy. It's very tech-led. Inflation is now falling enough to take the pressure off profit margins. And probably the third and least important one is that the economy is sort of hanging in there. So looking forward to next year, which I think is going to drive this sort of fourth quarter rally, is return to double-digit earnings growth, and the Fed and frankly the rest of the world beginning to cut interest rates and keeping valuations high.
That was Ben Laidler, the global market strategist over at eToro. Shares of KB Home are under pressure despite reporting better than expected results. You heard Ben there talking about earnings growth. CEO of KB Home, Jeffrey Metzger, saying, "We're well positioned to navigate the potential for shifting housing market conditions and have started to increase our investment in land acquisition to support our commitments to grow our community count." Bloomberg's Abigail Doolittle is here with more on KB. Abby?
Yeah, absolutely, Matt. If we take a look at KB Homes, we are going to see that the shares right now are currently down about 4%, and this, of course, having to do with what you were just talking about. It also has to do, of course, though, Matt, with the quarter. I mean, this stock is really plunging on the soft gross margins and the orders miss. And there have been so many questions recently, Matt, in terms of mortgage rates, the 30-year fixed mortgage rate going above above 7%, and that the idea that that could really crimp demand. It seems as though KB Homes is, in fact, seeing that. Barclays analyst Matthew Boulay is saying that the sequential order trends are in line with normal seasonality, but it's the fourth quarter guide that should be a little bit of a concern. At the same time, it could be as a trough, reflecting the orders from the weaker first quarter environment. But you take a look at the stock over the last year, Matt, and year to date, really up in a big way. So the fact that it's coming in just a little bit, is not so surprising given the weakness on the quarter.
Yeah, well, big beats we saw for the reporting quarter, right? In the third quarter, I think they had $1.80 of EPS. We were looking for $1.43. Beats on the revenue side as well. Abigail Doolittle on KB Home. RBC's Lori Calvasina weighing in on the outlook for earnings, writes, "Our EPS forecasts are moving up, which is unusual in years when they started out too high. Normally, consensus forecasts are stable after mid-year and don't move up this late." And Lori, I noticed something, in Ben Laidler's expectations that I see from a lot of people who are very optimistic about the economy, but also expect rate cuts. Can you really be both? Do we get, strong earnings growth and a thriving consumer, and then the Fed, for some reason, cutting rates? Why would that be?
I think that's a great question. I think that the Fed ultimately, and we heard a little bit about this yesterday, ultimately, does have a dual mandate. And so I think if we do see a little bit of, continued erosion in the labor market and inflation is already coming down and headed in the right direction, starting to get close to where it needs to be, I think they're going to have a very hard time justifying keeping rates as high as they've been. Our rate strategists have also talked about adjustment cuts. So, that gets a little bit more technical and behind the scenes. But I think goes to show that ultimately at the end of the day, whether or not they call it an official part of their mandate or not, the Fed is not ultimately, longer term at least, trying to derail the economy, even if they are, sort of willing to risk a recession in the short term. I will tell you, though, I think there are really interesting dynamics next year between earnings and interest rates and inflation levels. And, one of the things Laidler was talking about that sort of caught my attention was he was talking about as inflation come down, it helps, profit margins. And I think that's true to some extent, but I think we also need to keep in mind that as inflation comes down, it impacts revenue growth in a negative way. That's actually something we've got embedded in our earnings model. So very much, kind of our initial thoughts about next year are that inflation moderating, it's good for multiples. Ultimately, some rate cuts will be good for multiples, but at the same time, there's a negative impact on earnings. So you've really got to monitor the two cross currents simultaneously.
In terms of, I was thinking about this in regards to Japan, because they want to get on inflation before it gets too far out in front of them. But the problem with deflation is that you put off purchases until later. When you're looking at inflation, do you pull those purchases forward?
I think you can pull those purchases forward. But I think the other situation that companies have really been benefiting from is that when you have inflation, you pass higher prices along to your customers, whether those are consumers or other corporations. And we spent much of the last 2 years hearing companies say, hey, don't worry, we're going to go out and increase prices. And our customers get it because they understand the inflationary and cost environment. And they really can't argue with us. Well, guess what? That cuts both ways. Now that inflation is starting to moderate, we're starting to hear some companies talk about how that pricing environment is just frankly getting a little bit squishier. Some of them are declaring, hey, we can still pass through prices for a while longer, but others are admitting that it's not going to be that easy. And that's where I think the rub on revenues really ends up coming.
All right, Lori, awesome to have you on the program. Thanks for joining us. Lori Calvasina there from RBC. Coming up, the market-moving events you need to be watching out for. That's next in our trading diary. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg's The Open. I'm Matt Miller in for Jonathan Farrow. Time now for the trading diary, what you need to be watching this week. At the top of the hour, we're going to get existing home sales. And then on Friday, we'll get a BOJ rate decision. That could be interesting. The UAW's deadline to extend strikes is also noon Eastern on Friday, plus Fed speak from Mary Daly and Neil Kashkari. And finally, U.S. GDP is due next Thursday. So that's something that we can watch for on the economy. And coming up next, right now, today, in this very moment, the Bloomberg Global Credit Forum. John, Tom, and Lisa are sitting down with Jim Selter, Apollo Asset Management co-president, for an interview you do not want to miss. I'm Matt Miller. This is Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to bring you the Global Credit Forum from London, Bloomberg Television. It's going to be simulcast in just a couple of minutes. Plus, we're going to check in with Brian Stelter, former chief media correspondent at CNN. He's now at Harvard. He is the go-to voice on the global media space. And we've got Rupert Murdoch stepping down as chairman, going to become chairman emeritus at Fox and News Corp. So we really want to get Brian's thoughts on this. This is the passing of a baton in a big way. A legendary media mogul, Rupert Murdoch, stepping down. But first, let's go to John Tucker and get a Bloomberg Business Flash.
All right, stocks open lower, extending yesterday's losses as yields climb. The growth stocks, they're particularly vulnerable as policymakers delivered that hawkish hold. Jobless claims figures this morning adding to the narrative of higher for longer. Headwinds to the economy, they're rising. That's according to Sarah Hewen at Standard Chartered.
We're already seeing some signs of distress. The economy has been doing well, but there are special factors behind this current quarter's strength. Credit growth is slowing. Delinquencies are low, but they're rising. The job story is declining.
All 11 major industry groups in the S&P 500 right now are lower. S&P 500 down 44 points, 1% decline. Dow 168 points lower. The NASDAQ 100 down 216 points, down 1.4%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Matt and Paul.
John Tucker, thank you so much. We appreciate that. We got the S&P 500 trailing off a little bit here, off 1%. Bloomberg Surveillance and Bloomberg News' worldwide network of credit reporters are joining forces to host Bloomberg's Global Credit Forum in London, bringing together some of the market's most influential voices to share their insights on the health of credit markets. The one-day event will delve into both the risks and opportunities in debt markets today, and how this new era of credit will shape the global economy in the years ahead. So we're going to go to that right now. Bloomberg surveillance host Tom Keene, Jonathan Ferro, and Lisa Abramowitz assess the state of credit markets with Apollo's Jim Zelter. So that's coming to us live from London. We're going to bring that to you right now with Bloomberg's surveillance.
Thank you, guys. Appreciate it. Live from the city of London, home turf for me, no secret, my favorite city on the planet. And I can say that because we've got a home audience. Good afternoon to you all. A special edition of Bloomberg Surveillance from our Bloomberg Global Credit Forum. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. TK, we couldn't have planned it any better, could we?
Yeah, they came to me like 6 months ago. Julie had her people call me up, and Julie said, we got to do this panel. I said, I don't want to do it. And I said, okay, we're going to do this panel, but we need some theatrics. So she said, look, if we can arrange the Fed and the BOE, particularly the BOE, 5-4 decision to blow up the bond market over 48 hours, we could probably get Zeltner, and that's how this started.
Let's get the 2-year something close to 520,
Yeah.
a 10-year up to maybe 450.
Yeah, but the problem is that the volatility, as Jim was saying, is all in the 2-year, the 10-year, the 30-year. It isn't in the credit market, which is what you would expect. And people have been wondering when will it actually matter for the fact that it's getting more expensive.
Yeah, it's real sophisticated. Yield up, price down. Price down means assets are challenged. I don't care what flavor you have here of the ice cream of the fixed income market. The answer is coming out of this, dare I say what BOJ does tomorrow, we've got moonshots in certain series. And what I'm focused on more, and this is my first question to Jim, is going to be the 10-year real yield.
We're all living this right now, and I think slowly over the last couple of months and then quickly internalizing that high for longer message across various central banks, but particularly the Federal Reserve. We're internalizing that increasingly, Tom. We're seeing it in the Treasury market. Risk assets really resilient in the face of all of this. You're talking about real yields, real and nominal, near cycle highs, and risk assets just pretty steady still.
There's no question about that in the last 18 months, but I'm going to go to the memory of Jim Curry out the door at Goldman Sachs, and Jim Curry and hydrocarbons there. He said, look, the real yield changes. It affects everything in the real economy, including all the investments of Apollo, really everything out there. There's no question.
Jeff Curry's not in the audience
he is
this
not
afternoon.
Here.
Okay.
Excuse me, Jeff
Good.
Curry, excuse me.
Jeff Curry,
It's
yeah.
late
Jeff.
in the day. I did
It's
an
the first
all-nighter
hour,
last
Tom.
night.
We're only 3 minutes into this.
There's plenty of time for more.
Do you want to bring in the guest?
I'll bring in the guest right now. This is fun, and it's really fun given where the markets are. He played lacrosse at Duke University, and I went back and I looked at the first day that Jim walked into Apollo, and the real yield's about back to where we were in 2006. We've come full circle. First of all, what was the first day like at Apollo, and what does it mean that the real yield, the 10-year real yield, is now back to where it was in 06, 07?
Well, first of all, thanks for inviting me today. I'm excited to be part of this great road trip. Taking you back down memory lane, Apollo was a much smaller business back then. We were probably 20 billion in assets. We're 650 today. The role of banks was much different. There was a massive risk appetite at that time in the world. But certainly, if you go back, I think the world was very different. And I guess I would start out today saying, as you guys talk about, where real rates are, basically what you're really saying is the cost of capital has gone through a massive reversal. And so all the activity going on in the last 18 months between all the central banks of the globe, that was the mechanics of getting to this destination. But now we have the rebalance, we got out of balance. For 10 years, debt was priced way too cheap. And you were forced to go into equities, and basically debt subsidized a massive amount of equity returns. And so the last 18 months, the world now has about 300 trillion in debt on 100 trillion in global economy. Those numbers are up basically doubled in the last 10 years. And when you go from 0 to basically 4 or 5%, that's 10 trillion of borrowing costs that have to be absorbed. And so there's a massive balance going on between debt versus equity and versus balance sheets. So
folks, we're going to turn this into a 2-hour seminar, given where the markets are. We're arguing about that.
I'm not sure they want this to become a 2-hour seminar.
The answer is I'm going to let Lisa and John do the heavy lifting here. I got one more question, which is the memory of 1998, which was about leverage in the system. It was about shadows in the system. Now that we're back here, and with the first and second derivatives of how we got back here, where are the shadows now?
Well, certainly wherever there's an asset liability mismatch, SVB was a perfect example of that. People talk about regulation. It was just a simple, not how you operate a financial services business. Where are there ALM mismatches? You know, certainly I don't think it's in the world of private credit. I think it's probably a lot of consumer finance challenges around the globe right now. You've got way too much public debt right now. There's challenges. So there will no doubt be challenges over the next 24 to 48 months as you've got fund companies that have funded debt-laden balance sheets of companies that have funded growth CapEx, and they cannot pay the piper right now.
Everything you said in your opening remarks is what Lisa wrote about for the best part of a decade, right? Complaining about the previous regime. We're all trying to figure out if this is truly a new regime or just a moment in time that we move away from pretty quickly. Can we live with where real rates are right now? Can we live with that?
Well, I think that it's sort of reality. We're getting back. You say real rates. I say cost of capital. It's cost of capital for everything we do. If you think of the last 10 or 15 years, the growth of technology companies, the growth of biotech, there's some great companies out there, but they were funded with the equity had all the benefit, and the zero cost of debt is not really sustainable. So this is the real world right now. Real rates are going to be higher. The cost of capital as we go back to this balance. And I don't think it's a surprise this week, as we were talking about earlier, the FT op-ed by the two finance ministers of France and Germany talking about the European financial services sector and the role of banks. So there's a parallel path here, conversation about how companies finance, how they had access to capital, the role of savings and securitization. So it really is all tied together.
Although, are we really living with rates where they are? I mean, we take a look at these average rates, we see them in the numbers, but that's not what anyone's actually paying. Companies have already termed out their debt. So are we living with it, or are we going to see what it looks like to live with it in a year?
I think we're not seeing it. So to highlight that comment, the mechanism, the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. In the U.S., you have a mortgage market with 30-year mortgages at a 3% interest rate. You have the high-yield market with a 6% coupon and an 8-year duration. So the real impact of higher costs around the globe in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical. I see a world where financial conditions have gotten tighter, and it's just a question of how long that transition mechanism, which will probably be longer than it's taken in the past.
There are a couple different ways for us to get to something other than a soft landing. There's the crash, and then rates going back down. And then there's something where it's just sort of a stagflation light or a stagflation proper, where rates remain high for a very long time and growth just slows substantially. It seems like the market is leaning into the latter. How much does that change your perception of what's going to happen in the credit space?
Well, this conversation is going into one where we need to get Torsten here, because he's the economist at Apollo, not me. But certainly what you're talking about is an environment where growth is more challenged, and with, you know, how do companies access capital with a new price of marketplace? Certainly you have challenge, whether it's in Germany or in the UK, with a slowing economic growth. But there's a variety of aspects that we would see. You know, unemployment, while still very low, it's going in probably a more challenging direction. Delinquencies are going up. Defaults are going up a little bit in the leveraged loan market, in the high yield market. Recoveries are lower. So there's a lot of points that would say to you that there's going to be a more challenging, tightening financial conditions. But certainly for us, the U.S. has been quite strong. The UK, there's still a lot of areas to lend. There is on Western Europe as well. So I guess the theme that I would take away from this is that we're going from a decade of a real imbalance where the equity was the big beneficiary, debt paid a crazy price. That balance has been completely changed 180 degrees. And now, how do companies navigate? How does the financial services, how do banks, how do alternative asset managers, how do we all balance and navigate this marketplace ahead of us?
Is this the return of the bond vigilantes then?
Well, I do think when people talk about, you know, when the central banks are going to actually lower rates, I think it will happen well before they actually get around to it, just like it happened on the upside in terms of rates. There's no doubt that one of the challenges of the last 15 years of the regulatory environment is you've had so much capital withdrawn from these marketplaces in terms of trading desk capital. So the amount of capital to trade $100 or $1 billion of 10-year treasuries right now, that has a greater impact. So there's no doubt that any kind of activity in the secondary markets will have a pronounced impact. And that's just the way of the regulatory impact post GFC. But for us, I mean, if you're in my seat at Apollo, there's been 4 trends since I got in the business. There's been massive technology improvement, there's been massive globalization, there's been massive deregulation, and the 4th, there's been a decline of interest rates. Other than technology, you're probably having those tailwinds be massive headwinds as an investor now. So how do you navigate that? How do you organize yourself? But I do think in terms of investors, it's a time to be
The technology change is the Bloomberg terminal. In case you didn't
Everyone needs a Bloomberg terminal. Is that the pitch? We're done.
Yeah, that's the
pitch.
Okay, we're done.
Earlier in the conversation, Jim mentioned that joint op-ed that was in the Financial Times. The headline, for those of you that didn't read it, we must close the EU capital markets gap. Can you talk to me about how Europe goes about doing that? Because me, Tom, Lisa, this whole audience has heard that 1 million times in the last 10 years. How do we close that gap?
Well, I think, let's talk about how we got here. We got here post-GFC, where a lot of tools that have been used to push risk out of the banking system that I think have been successful in some regions of the globe, the European regulators took a different view. They took a dim view of securitizations. I would argue that if you look at securitized product, that's actually been very good for the banking system in aggregate. It's pushed risk out to the real owners of risk. If you look at other things that they talk about shareholder activism, but I do think there's got to be an embracing of these types of tools to allow greater activity, because I think it's creating a bit of financial services stagnation.
Torsten Slot called me up one day and he said, you know, you really ought to look at the Austrian piece. So I loaded the boat on the 97-year Austrian bond. That really has worked out well. I'm down like 70% or whatever. Tell me about what duration's going to do and choice of duration is going to do, given this new environment back to 06, 07, 08.
You know, again, when I think about the world, I think about long duration, but what we do at Apollo is we're really trying to figure out places where we're not taking credit risk or duration risk. I'm just creating great spread. So whether it's fixed income replacement, I certainly believe that the world has been on that textbook of if you want to make money in fixed income, you got to do duration. I think it's an interesting way to look at the world. I think you're getting paid right now on risk-free rates to some degree, whether they go a little bit higher or wider. I certainly know for us at Apollo, whether it's in the investment grade world, public and private, whether it's in private capital, when we can make high single digits, 10%, being a lender, that's a great business.
Do you hedge into that? I mean,
we do. Our business, most of our business is unlevered, but if we do have any kind of leverage in our business, we match ALM, complete asset liability matching all the way through.
So what's better for you now, right? Private or public? You said that private is sort of immune, and yet a lot of people think it's just not traded, so you can't see some of the carnage that you see in some of the IPOs of ARM and Instacart. So what's your view there?
Well, I think certainly if you look at an aggregate, it's hard to make money in the public markets and is an aggregate statement, equity and debt. Certainly with the valuations where they've backed out in terms of where rates are right now, a risk-free rate, yes, there's some opportunities in the investment grade world. But if you look at high yield indexes and leveraged loan indexes, they're arguably rich. They're rich for a lot of technical reasons. And so our ability, again, when we talk about private credit, most people, you talked about earlier, they talk about really the sponsor finance market. Right. The reality is, whether it's inventory finance, trade finance, solar finance, there's a massive $30 to $40 trillion opportunity in terms of the TAM. So that's where we're spending most of our time, creating great, safe spread yield, really on investment grade companies.
This sounds like a bank.
Well, I would say is we are a credit lender. We provide credit, and we do it in a manner where we're not using a balance sheet that we can lose deposits tomorrow. We have long tail liabilities, and we match those.
A lot of people have said, particularly in the banking sector, they're going after their lunch and that they have to follow pretty significant regulations, and you don't have to, and you have fixed capital. And it's kind of what it sounds like in terms of the size and the scope that you need to achieve.
it's kind of taking on a lot of the functions that banks used to fulfill. Is that the business model right now?
Well, I think our business model, so if you look at our $650 billion today, $350 billion comes from retirement services balance sheets, fixed annuities. The other half is the GP model. We're able to lend money to Air France, to Vonovia, the big German real estate companies. We can do that in a manner where we are solving the company's problems, and many times we're doing it in conjunction with a advisor or a bank. There's a narrative out there that we win, the banks lose, or vice versa. The reality is we are doing more in collaboration than we've ever done before. We have a big venture with BNP in inventory finance. They've got an amazing franchise. We partner with them so they can manage their capital in a more efficient way. But the reality is there's more collaboration. And people say, are you frenemies? Are you opponents? Are you competitors? It's all the above. We work very closely with them, and they work closely with us.
Should we make some news? There was a headline yesterday, Apollo looking to raise about $2.5 billion to lend in private markets, according to people with knowledge of the matter. We're talking to someone with knowledge of the matter, maybe. Yeah. Are you looking to raise about $2.5 billion to lend to private markets?
You know, we're an active player in the extension of senior loans to sponsors. We're active in many of these businesses. We've got a $425 billion credit business. The fact is, we built this business not expecting real yields and absolute yields to be at these levels. We thought it was going to be lower for longer. We created all these origination platforms. So the reality is today, investors around the globe are clamoring and they're saying, wait, on a risk-adjusted basis, we can do this in the credit markets or in the debt markets. Why do we need to take that equity risk? And I think that's why you're seeing a preponderance of conversations about from sovereign funds to foundations to pensions around the globe saying we can make what we had to take equity risk in the past, we can do it on the debt side of the balance sheet.
I think that's a yes.
Was that a yes? Was that a yes, Brandon?
That's a
I think
yes.
so, yeah.
You are looking to raise $2.5 billion.
We're raising we have a large platform. We're one of the handful of great players in the world. We're raising
wait, how does that work? Do you make like 6 phone calls? I mean,
you know, I travel quite a bit. If you ask my family, I travel a little bit more than those 6 phone calls. But, you know, we have several thousand LPs around the globe, and my schedule could be packed up going to visit them.
I can see Apollo PR right now. Jim, you were not meant to say yes. Just keep talking. Don't answer the question.
There you
Jim,
go.
let's go back to Spring. Spring was really messy. Banks failed in America. Yeah. And I remember sitting there, and we had guests come on the program with us on Bloomberg Surveillance, and lots of guests said, we've started a process here. It's the end of the cycle. There's going to be a hard landing. It's only several months ago. What was that?
I think it was an expectation of what was happening at that moment was going to happen completely. And the reality is this is a big, broad global economy. The consumer plays a massive role in it. Back to my comment earlier about 3% mortgages on 30 years. The U.S. consumer really has not, we may have taken rates up, but the real impact of this higher cost, the second, the third derivative, it's early still. It's really early, and I think that's the difference between, you know, there is no doubt the health of the U.S. consumer is what's allowed us to extend the economic cycle, but I think they're eating through some of their savings, and there's no doubt that there's the tightening of financial conditions is going to be out there, and, you know, we're finding more companies coming to us trying to solve their financing needs going forward.
There are other firms challenged because they decided they were going to go off and do something different, new, original, and they're selling things for a haircut. You're probably involved in those transactions. How do you avoid worst practices? You guys have grown this thing from next to nothing. The private world is in right now. You're doing a brain drain. You're taking all the smart guys from Wall Street over to Apollo. Everybody knows the ballet. How do you avoid the worst practices we observe every day on the show where things blow up for Wall Street?
Well, the biggest accident you can do as you grow is to offer people liquidity on illiquid assets. And so I don't think it's a surprise. We're not in the business of offering daily liquidity in any of our products. We run our products, we really match the assets to the liabilities. And again, I think that's really a core to how we run our business. The second is for the last 6, 7 years, we've continued to go senior in the capital structure. We're doing more investment grade companies. We're doing larger companies. Witness what we've done with, as I mentioned earlier, Air France or AT&T or Vonovia, big quality companies. So Also, when we underwrite something, for the most part, we bring in partners. We want others to take a look at what we've done. We're really good at underwriting credit risk. We brought a lot of that credit oversight that is so valuable at many of the financial institutions. But we have to make sure we're really measured and we focus on the 3 businesses that we're in right now.
Jim, what are you doing with the books that you already hold of debt and equity that is valued much lower?
Yeah.
I mean, it's one thing to talk about future lending opportunities.
Sure.
What about the ones you already did?
Well, let's talk about our business. So today of the $600 billion, equity is around 1/6 of our business, about $100 billion. We've been very, very clear in our private equity business in our flagship vehicles to fund more so with fixed rate debt and really extend those maturities. For the most part, we have been really not levering to the max. If you could lever companies 5-6 times, we typically borrowed about 3 to 4 times. So we didn't borrow as much, and we did it for term at fixed rates. That's a really important. What we learned in 08-09, it wasn't we were the smartest guys in the room, is that we had the best capital. And if you had the best capital and didn't get pulled away from the table, that's usually a critical aspect of success.
That takes us to our final question to wrap things up with you, Jim. In a world of high uncertainty and low confidence, do you have a high conviction call looking out in this market right now?
Well, I think that you have to assume, I think there's going to be what we call some big fat pitches out there. The reorganizing and the restructuring and the refinancing of the entire CRE universe. You have to be marshaling resources around that. You have to make sure that if you are lending capital today, you're doing so on senior basis with a tremendous amount of equity underneath you. So for us, I mean, certainly we're in 3 businesses. We've been very, very disciplined about what we've done. We have added a lot of human capital. It's been amazing for our company to pivot and grow, but really to make sure that we stay true to our alignment, our risk-adjusted returns, and making sure that purchase price does matter. We are very focused on the creation value of our businesses.
Man, you lost last night?
Is that what happened against Bayern Munich?
Is that an opportunity?
Is that an opportunity, what, to go to the Glazers? And
Yeah, they
ask
lost
for
to the
club?
Harry Canes. So
You really are trying to make some news.
Yeah, I'm trying to make some
Do
news.
you want to buy a football club?
You know, we have an active we have an active lending business, and we've done a variety of things in the world of sports entertainment. But
You're on script.
we really
I think that's
are.
a no this time. I think that's a no.
Yeah.
Can we have a round of applause for
Yeah,
Apollo's Jim
thank you.
Zelter? Jim, thank you. Thank you very much. And thank you to all of you for joining a special edition of Bloomberg Surveillance, live from the City of London. Thank you to you all. I'm going to throw it back to New York.
All right, that was the surveillance team, Tom Keene, Jonathan Farrow, and Lisa Abramowitz, talking with Apollo's Jim Zelter about the state of the credit markets. And, he obviously, Matt said, talked about the volatility in the credit markets, but they feel pretty good about where they are in terms of their position in the capital structure and their how they've navigated some of the challenges really over the last 10, 15 years coming out of the great financial crisis. So some good stuff there. Right now, let's reset here, and we're going to do that with John Tucker.
And across the board, Paul and Matt, stocks are lower right now. The S&P 500 falling below the 4,400 level. So the much-awaited pause from major central banks, that's arrived, yet stocks are falling. Chair Powell noted in his press conference yesterday, soft landing for the economy. That's not his base case at this point. And then we had data this morning on jobless claims that seems to underscore the case for high rates for longer. In the S&P 500 right now, we have 10 of the 11 major industry groups. They are lower. The lone sector in the green, that belongs right now to energy and technology, especially taking it on the chin. NASDAQ 100, 176 points lower, adding to yesterday's losses, down right now 1.2%. The S&P 500, 37 points lower. That is down about 0.9% at 43.64. And the Dow Jones Industrial Average, 107 points lower. That is down 0.3%. Two-year yield, 4 basis points lower. That's at 5.12. Now the 10-year, the benchmark, that's at 5 basis points right now at 4.46. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio. Let's continue our discussion on the credit space that we had with Apollo's Jim Zelter over in London with the surveillance team. We bring in our good friend Liz McCormick, chief correspondent, macro markets with Bloomberg News. Liz, I'm looking at the, coming off of the Fed yesterday, the Bank of England today, holding rates steady, but the Fed, I guess we're calling it a hawkish pause. Is that a way to think about it?
Yeah, and they seem to really nail it, because sometimes I think they try that and it doesn't work, but they definitely, obviously, pause, but they laid out pretty clearly in their so-called dot plot that rates are just going to stay higher. I hate to keep using that term, but higher for longer, right? They took out 2 of the cuts, at least the officials in their quarterly forecast, that they kind of penciled in for next year. Instead of 4, now there's 2. They're still signaling 1 more. And I think it's really about, because I think it's, there's a lot of people saying the Fed may be done, maybe they don't hike again this year, but that, like you're laid out, like John Tucker laid out with the markets, that doesn't matter. It's more about that probably no time sooner we're going to see the Fed and other central banks, major ones, pivot to easing. And I think that's what's taken over the market. Rates are higher, stocks are on the back foot.
Liz, we got jobless claims out at only 200,000 this morning, so lower than anticipated and lower than last time. Labor market looks strong, and we're hearing from everybody that earnings growth is going to bounce back to double digits next year. Why does the Fed pencil in any cuts to rates?
Well, this is kind of an interesting, wonky thing. Now, who knows? There's some people saying, and the next update, maybe they take out more. So they could, Matt. But technically speaking, the way they're restrictive is real rates, right? Nominal rates minus whatever inflation measures you use, forward expectations, et cetera. So if, say, they keep rates the same, but inflation keeps going down lower, that means the policy is actually getting more restrictive even as they stand still. So that's why I think officials still have 2 cuts priced in for next year, because maybe they're figuring by the second half of the year, inflation has come down more. And if we don't cut rates, we're actually tightening. It's kind of weird, even if they're doing nothing, right? So I think it's just kind of mechanical, trying to remain the level of restrictive they want without getting more restrictive.
Well, what about, they now expect rates to be, I think, 3.9% at the end of 2025 and 2.9% at the end of 2026. Are they just trying to get back to zero? Are we all just so used to low rates that we want to believe that that's the natural equilibrium of things?
Yeah, I think those longer dated stuff that you mentioned is a strong signal. I think we're, barring some unforeseen major crisis, which I don't wish for, I think we are a long way off from ever going back to that 0 rate world. Chairman Powell, even yesterday in the press conference, which I was kind of surprised, kind of alluded to, that R-star real policy rate, that, yeah, it could be higher. We don't know yet, but it could be because, economy is more resilient, other forces. So, yeah, I think, Matt, if you look way out, it's like we're a long way. Just think about it. We're at Fed funds at 5% if the dots work most of this year and next year. That's high. And then, like you said, not going down too much into the next couple of years. So I think it's a new rate regime for sure compared to pre-pandemic.
All right, Liz, thanks so much for giving us a few minutes. Really appreciate getting your thoughts. Liz McCormick, chief correspondent, macro markets with Bloomberg News. Well, in the world of media, major piece of news coming out this morning. Rupert Murdoch is stepping down as chairman of the boards of Fox and News Corp following a nearly 7-decade career and will become chairman emeritus of each company. His son, Lachlan Murdoch, will become sole chairman of News Corp and continue as executive chair and chief executive officer of Fox, the company.
Succession.
Big time succession in the real world. You need perspective on a story like this. There's only one person to go to, in my opinion, and that is Brian Stelter. He is a Walter Shorenstein Fellow at Harvard University. Most of our audience knows him as a former chief media correspondent at CNN. I also know him as a former media reporter at the New York Times, so he is the voice to go to. Brian, Rupert Murdoch defines media mogul. So pretty big move here today.
It is, and in some ways it is surprising because Rupert Murdoch always said that he would never retire. That's what son Lachlan said about a decade ago as well. Lachlan was clearly being groomed to be the successor that's been in place for a few years. Today just affirms and confirms that Lachlan is the chosen son. But all along, Lachlan had to share power with his father, and the idea was that Rupert would never retire. Well, today is the closest thing to a retirement that we're ever going to see from Rupert. His allies are calling it more of a semi-retirement. He is saying he'll be very involved, watching, reading, responding, giving feedback. But this is clearly a turning point moment for both News Corporation and Fox Corporation to have Rupert moving off the board as a chairman, moving into an emeritus role. There is obviously no turning back from this, and now this cements Lachlan as the leader of both companies for better or worse. And I think there's a grand debate to be had about Lachlan's leadership, the pros and cons, and what it means for shareholders.
You know, there are a lot of businesses in which it doesn't really matter who's the CEO or the chairman. If you've got somebody holding a big stake in the company, he's still the boss or she's still the boss. Is that the case here? Does Rupert Murdoch have to be chairman and CEO to run the business, or is he still in charge of the family?
He's still in charge of the family, and he still controls the trust. And that is the part of this that is very much like HBO's Succession. The storyline on Succession is very much how it works in the Murdoch family. There are a bunch of votes of the trust. The trust controls both Fox and News Corp. And in the event of Rupert Murdoch's death, there will be a battle for control of both companies within the Murdoch family. People may know that the outlines of this. 4 adult children, 2 of whom, James and Lachlan, have been warring, have been battling for years. Also 2 women, Elizabeth and Prudence. In the event of Rupert's death, they each get 1 vote. And so there is no tiebreaker. There will be some sort of reorganization of the companies in the event of Rupert's death. But it's important to note in the memo this morning, he says he is in robust health, and he's been around the Fox studio lot in Los Angeles this week, according to my sources. So I think what we're seeing today is a sort of confirmation that Lachlan is the chosen one of the father. But that does not mean that there could not be any number of changes in the years to come.
Brian, is there any reason to believe that with this news today that there could be any change in editorial view strategy at Fox?
Right. I think that's one of the most interesting questions. And the initial answer is no, because Lachlan Murdoch is as conservative and in some ways more conservative than his father. They have many of the same political views. They both have some distaste for Donald Trump. Rupert Murdoch, much more critical of Trump than Lachlan has been, at least as far as we know. But both men, although critical of Trump, are definitely and defiantly conservative. I don't think we're going to see the brands change direction in a dramatic way. What we might see, and this is the question mark, and what I'm really curious about is, what will Lachlan Murdoch, maybe more free, not entirely freed of his father, but perhaps more free than he has been, does he have plans he'd like to put in place? Does he have business ventures or strategic shifts that he's not been able to pull off because of his dad? We know the general direction is the same, right? Toward streaming, toward getting Google and Facebook to pay for News Corp's properties. All of that will continue. But, I guess, are we going to see Lachlan emerge from his dad's shadow now, I think is an open question.
How do you think, when we look back on this, Brian, I know you've got so much history and experience with the Murdoch family and the News Corporation. How do you think Rupert goes down in history? Certainly, when I think about, the media moguls, Sumner Redstone, Ted Turner, a couple of others, John Malone, he's right there at the top of the mountain.
Yes, in moving us from a broadcast to a cable and then a digital world, absolutely. There are some accomplishments that you have to give credit for. The creation of the Fox broadcast network. We wouldn't have The Simpsons, and Family Guy. There's a lot, there's so much that has Rupert Murdoch's fingerprints. Of course, that also includes Fox
Brian.
News.
I mean, he's created an entire political movement. Doesn't it feel like that?
It does. We would not have had a Donald Trump presidency without Rupert Murdoch and Fox News. The polarization of Fox News, but also the diversity of voices. We could argue it in any number of directions, but the impact is very clear and spread out all around the world, including in Australia and the UK and other markets. There's a satellite network. A lot of that is a part of Rupert Murdoch's legacy. Now, I would say on the business front, he had impeccable timing, selling most of Fox to Disney about 5 years ago, providing more firepower for Disney in the streaming premium wars, but also getting out of some declining businesses. If you look at the stock for Fox Corporation in the 5 years since it was spun out, it's down 23, 24% over 5 years. News Corporation has fared somewhat better, but if you're an investor in these companies, you are not altogether pleased by Rupert Murdoch's performance in recent years, as these companies have faced headwinds of the Apples and the Disneys and the Googles, these much bigger giants that now control the media and tech landscape.
And Brian, that kind of calls into question, again, a lot of folks say maybe Rupert was the smartest person in the room selling to Bob Iger when he did. What does Bob Iger and Disney do now? Because they've said, unlike Rupert, we're staying. We're going to try to evolve and compete in this new media world. How do you think that plays out for Bob Iger?
Right. And to me, I think about it as a consumer. How attached am I to Disney as a consumer? How invested am I? How much do I have to spend to go to Disney World, Disneyland? How much do I have to pay for Disney Plus? And I think Disney has its hooks in consumers better than any of these other media companies. That's why when I look at this landscape, it's Disney and, of course, Netflix that would be the ones that I would be wanting to bet on. That said, the challenges are enormous. He is saddled by assets like the ABC television network that are no longer deemed desirable. And how he's going to navigate out of that, to me, it's a very treacherous 1-2 years ahead. To me, in 10 years, I'd still rather be Disney because they're still going to have their hooks in so many families that have to go meet Mickey Mouse. But in that short term is so murky.
Is there a future, or what is the future for cable news, do you think?
For cable news, well, Fox News is the strongest of the pack. All of these companies are facing secular challenges. We know about the headwinds. But Fox News, for all of its faults, and I believe there are many, it has a captive and loyal audience almost like anything else in television or in media. And I do see some challenges around the edges. Tucker Carlson's firing did cause a ratings drop, but most of those viewers have actually come back to Fox News.
Yep.
So if you were betting on a cable channel out there, you'd probably be betting on Fox News. Again, for better or worse, right now they're getting ready for their next GOP debate. The Republican Party gave Fox the first 2 debates, not Newsmax, not Rumble, not some far-right internet stream. Republican Party still went back to Fox. So that alliance is still very real and very strong and, frankly, very profitable for Lachlan and Rupert.
Brian, thanks so much for joining us. Really appreciate you giving us a few minutes of your time. Brian Stelter, he's a Walter Shorenstein Fellow at Harvard University and a former chief media correspondent at CNN, also a former media reporter with the New York Times, so certainly has the chops to give us his perspective on Rupert Murdoch stepping down as chairman of News Corp and Fox. Right now, let's get a reset here. We'll go to John Tucker and a Bloomberg Business Flash.
A lot of red on the screen right now. Every major industry group in the S&P 500, Paul, lower, and the index extending yesterday's losses were below the 4,400 mark on the S&P 500. You have consumer discretionary category. That's the worst performer right now. Tech-heavy NASDAQ 100 feeling the pain, too. That's down over 1%. The rates picture weighing heavily on the growthier stocks. The Fed delivered that hawkish pause on rates yesterday, and data this morning supporting the idea of higher rates for longer. Jobless claims registering the lowest since January. But despite sounding hawkish, Andrew Sheets at Morgan Stanley says the Fed is done raising rates and will cut rates next year.
Sounding more hawkish now, sounding more serious, sounding more vigilant on inflation is the smart move, especially in a world of uncertain data and very high, uncomfortably high inflation over the last 12 months. So I think the Fed would much rather be in a place where it can be positively surprised, where it can talk somewhat more hawkishly now.
And more data this morning, sales of previously owned U.S. homes, let's call them used homes, shall we, declining in August to the lowest since the start of the year. S&P 500, 34 points lower. That's down to 0.8%, 43.67 on the index. The Dow Jones Industrial Average down 101 points. That's a decline of 0.3%. The NASDAQ 100, 137 points lower, actually parrying some of the earlier losses. Right now, down 0.9%. Some of the individual shares on the move, among the most active, shares of Splunk, 21% higher. Cisco buying the company for $28 billion.
Splunk.
I don't know where they got that name from.
No,
but
I like it though.
It's cool.
Yeah.
Anyway, that's your market check. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, Matt, and Paul.
Matt, he's not kidding. He checks markets all day long.
Yeah,
Tucker does.
He does. John Tucker wakes up in the middle of the night to check markets.
To check markets, yeah. Absolutely.
2 o'clock this morning. And I was checking the markets.
Yes, you were. And we're all the better for it. John Tucker, thank you so much for that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on that YouTube internet thing, so head over to youtube.com and search Bloomberg Radio. We have central banks kind of staying put here, at least for the near term, both the Fed yesterday and the Bank of England today. Markets adjusting to that, as John Tucker was just reporting, the S&P off 0.75%. Let's see where we go from here. Katerina Simonetti joins us. She's the Senior Vice President, Private Wealth Advisor at our good friends over at Morgan Stanley. So, Katerina, I guess yesterday with the Fed, it was kind of as expected. They're staying put, but they're saying they're still focusing on inflation. So maybe they're going to stay a little bit higher, a little bit for longer. What did you take away, and does it change your outlook for your clients?
Well, you're 100% correct. The Fed acted as expected. We expected that they're going to take, a breather from the rate hikes, but it is a very data-driven Fed. So, and data has been conflicting. Just let's take a look at this week where unemployment numbers are down, and yet, it's very clear that there's some, economic pressures out there, specifically with the rates, being so high, and, that is affecting consumer in one way or another, so we see this consumer confidence coming down. So most likely this is it, and they might not raise rates anymore, but they're leaving the door open for November. And if the data warrants it, they certainly will do it, because inflation is not quite, where they need it to be. It's not at 2% yet.
So you expect another hike then, and next year, do you think we have reason for rate cuts?
Well, when we look at the broad consensus, it looks like, there is a general expectation that Fed is going to start cutting rates next year, but maybe not quite as aggressively, and it's all going to be driven by the extent of the economic decline. And, we're dealing with the environment where earnings are under pressure. We started the year kind of expecting the pricing in the hard landing, then it switched it into the soft landing, and, it looks like that's the way we're going to go, but we can't discount the risks that come even with that scenario, especially, now that it looks like we're going to be in the higher interest rate environment somewhat for longer. So we are expecting rate cuts, but probably it's going to be fewer of them and, later in the year, next year.
So given that backdrop, Katerina, are there sectors or are there factors that kind of guide where you're recommending your clients allocate capital?
Well, absolutely. And there is a short run and there's a long run. And in the short run, we tell investors to stay invested, but stay defensive and focus on sectors like industrial or healthcare, for example, that has both growth qualities and income qualities, as these stocks pay really good dividends. We also tell investors to focus on cash. It's not typical where we can make some really good rate of return in our cash deposits, but also not forget about bonds, because eventually rates are going to start coming down. And in order to enjoy the higher interest rates for longer, we have to be in investments, in fixed income that, will extend that interest rate for longer. But when we look at the long run, we also, are expecting that this cycle eventually is going to come to an end and the new growth cycle is going to start. So a few years out, it's certainly, it does not hurt to be opportunistic.
So, but now though, aren't bonds a screaming buy at these levels? Even if you don't get capital appreciation from a price drop, you're still getting a 4.5% rate on the 10-year. That's strong. And then, don't you sell stocks here?
Well, to put it in perspective, I became financial advisor in 1999, and that was the only other time in my career where I've seen rates at this levels. So I think we should understand how unique it is to have these access to high interest rates, and we should take a full advantage of them, knowing that we might be in the environment like over the last decade where rates were not close to where it is. But this does not mean that we need to sell our stocks. We have to stay true to asset allocation, because it is that complete asset allocation where we have an appropriate allocation to stocks and bonds and cash that is going to eventually get us to where our goals are, but this does not take away from how special the rate environment is.
So, a lot of folks tell me at this stage of the cycle, focus on quality. I'm never really sure what quality is. Is it quality balance sheet? Is it quality management? Is it quality earnings quality? How do you guys think about that?
Well, all of the above. Valuations certainly matter. Competitive advantages matter. The ability to, enjoy dividends from our stock investments. So when we look at the quality, or let's call them defensive sectors, these will be industrials, materials, financials, healthcare, consumer staples. When we think back of the COVID, right, where the consumers will pull back on spending money on some discretionary items, but will still buy necessary items. This is what we think about when we look at the defensive sectors that are going to be growing and are going to be profitable, in any market environment. And that's what we're telling our clients to stay with for the time being until, we get through the end of the cycle and until we get into more of a growth phase.
All right, Katerina, thank you so much for joining us. Appreciate it. As always, Katerina Simonetti, Senior Vice President and Private Wealth Advisor for Morgan Stanley. IPOs, Matt. We had Klaviyo?
Klaviyo is the correct way to pronounce that company, which is a back-end software as a service provider for APIs.
Look at you with that, right off the tongue. He had it. Stock opened. We're trading at $33.59, up 2.5%. So not that first day pop that we'd seen with ARM, Instacart, which, by the way, they've kind of given up those first day
ARM
gains.
is back down, right?
Yeah,
and
yeah,
I mean, they
same
all three seem to have had a pop on the first day and then given up the gains. But Klaviyo, if you're focused on application programming interfaces, then
and who's not? I mean,
you got to get in.
When you come think
I mean,
about
I think all this talk about the tech aspect of the firm. I'm pretty sure they're just an email marketer.
Yes.
So they spam you,
but I think
they help spam you.
I think they were trying. They're going for it's a cloud play, a software as a service kind of thing. But anyway,
I'm going to find out later because Mark Douglas is coming in, and he's one of the smartest guys.
Yes.
In this area. I still don't even understand what his company does, Mountain, yeah. But I'm hoping he can explain to me what Klaviyo does.
Okay, KVYO is the ticker. Stock's IPO'd, I think, at
$30 yesterday.
$30.
So it's still up $3 and change, right? $3.52.
Yeah. So that's it's holding on to its gains, up 1.9% today. So looking at that as well. So S&P 500, just kind of looking. I think just kind of giving us a little